Wow, day 28. Holy moly. Can we believe it? It's crazy, eh? Almost done, guys. Getting very close, down to the wire. Ebony, I like your hat. It's pretty cool.
Thank you.
Kelly, are you ready to rock or what?
The only thing I was going to try and do is see if I could see everybody in the group, but I can only see one strand. I'm sorry, I haven't been doing a lot of webinars, so I'm trying to figure out. Oh, there, I can see more people now. I can't see Brooke, Cecilia, or Ashley. Is that making sense to other people?
That's because they don't have their cameras on.
Okay. Okay, so I can see 1, 2, 3, 4, 5. There's 9 of us that I can see. Does that make sense?
That
Yep.
makes sense.
Okay, sorry. I always said this in 2019 in our year. I'm the dinosaur in the group. So you have to bear with me just a little bit.
Oh, don't worry, Kelly. We got you. We have lots of time. Lots of time.
Hey.
Awesome. Okay. Well, if you're ready to go, we're ready to go. Let me just switch my view here. So as I mentioned to you guys, Kelly is here talking to us today in our second of 3 kind of financial workshops. We're going to be talking about planning for a profitable business, but we are absolutely thrilled to always have Kelly grace us with her presence. And she is a former Leap In participant, an accountant extraordinaire, and the owner of a really amazing business called Inclusive by Design and a clothing line called Spunky. And we are very happy to have her energy join us today because it doesn't happen as often as it used to. We used to always be very surprised when you would pop into our office when you were working with the fashion design students, or many of the other times you would pop by. So this is nice as well to have you pop by on Zoom and meet some fellow cohort members. So thank you for joining us, Kelly, and thank you for being here. And I know I kind of butchered your whole background, but I figured your background was so extensive, maybe you could share a little bit about it with the students.
Thanks very much. And I'm delighted to be here. I'm very much at heart a leaper, and you guys are very near and dear to my heart and what we're doing. And anytime I have an excuse to come in, I'm delighted to. I got so much out of the Leap In program that I'm a fan. So I hope it's going well for you guys this year as well. I have to apologize right off the bat. My stuff is tough. It's dry. And for a lot of people, it's really uncomfortable. So can I just get a sense from the people I can see and from the people who are just on the phone, can you let me know, are you uncomfortable with numbers? Okay, yeah. Okay, so I'm not talking to a whole group of people who've got this all figured out.
If you are and you have your camera off, please throw up an emoji or something.
Okay, so my starting point is that a lot of you guys are going to be really focused on what you're doing, what your business concept is, and you know how to do that really, really well. You're figuring out all the logistics about that. And the number stuff will come later, and you can hire somebody to do that for you. And you know, you're small enough or whatever that you're not really worried about that right now. This is going to be a bit tough for you because you actually need to focus on this. And I'm really sorry about that, but it's just what it is. So I'm going to try and be comfortable and shoot me up a message or something if I'm getting into any jargon. I have based this presentation really closely to one of the, which module is it in you? Like originally it was module 8, but I think you've changed the numbers of the module.
Yeah, so this was module 8. It's module 8 in our manual, but this would be it's just under day 28 for us. So,
okay, so there's a couple of times in the slide deck that I've referenced the module number. So it's the manual module number as opposed to the day that you've been working on, okay? So the topic for today is planning for a profitable business. The one thing that I deviate a little bit from is that in the manual, it's really dealing on the planning for a profitable business. And I think you also need to know how to execute a profitable business as well, not just plan for it, but actually do it. So some of the number stuff I'm going to talk about is when you're actually up and running, what you need to be doing, because it's just so important, not just to build it into your plan, but then to be building it into how you go forward. So figure out sort of success, financial success for a business. Okay, you cover all your startup costs, you achieve profitability, and you can maintain a cash flow. Those are the things that, you know, the manual and everybody says are important for success, and that's how, you know, you can do all those things and you're being successful financially. Big question is, how do you do that? Like, it's great to be told you have to do that, but, you know, how do you actually step by step go about doing that? And that's part of what we're going to look at today. So I want to take a look at this slide here, and you'll see we keep coming back to this one. There's a planning cycle. I call it the planning cycle, but it's actually taking you through the cycle from the time that you plan to you transact and you record everything, you report, you monitor, you evaluate, and then you're back into the next year's planning cycle. So typically for a business, this would be year over year, you would go through this cycle. It can also be more frequent if some of your stuff needs it. And certainly the recording that you do, you get monthly reports and all that kind of stuff. That happens more frequently. We'll get into that a bit. So first of all is the plan. That's what everybody has to start with. As you get going, you have to start with a plan. Looking at this, the plan, there's sort of three aspects to the plan, or three steps to your planning. First of all, you research the heck out of everything. And you did a lot of that in your module 3, where you were identifying all your costs and you were trying to research and figure out, well, how are you going to figure out how much those costs are? And you looked at a lot of individual things. And so that's really great. So then the next step is, how do you take all that stuff and pull it together? So you have to compile that into something that actually makes sense. So you're not, you know, juggling all this stuff and you don't have any hands left for anything else. You need to be able to plop it into something so that you can look at it. So we're going to look at compiling that, which of course in a planning phase will be a budget. And we'll look, and I think you've looked at the financial statements, the income statement and the balance sheet and the cash flows and that kind of stuff. So that's another way that you compile financial information, is you group it together in ways that actually share, it takes data and turns it into information. Once you've got it compiled, then you take a look at it and you say, does this in fact make sense? Does this give me the result that I'm looking for, or the prospective results that I'm looking for? And if it doesn't, then you adjust it. So that's a lot of what we're looking at today is that assessment and adjusting bit, as well as the compiling piece. Okay, so just wanted to give you a bit of an orientation. So now we're going to sort of start to go into things, but hang on, before we go charging off, I do actually want to review just a few things here, because otherwise we'll just get going and we'll lose our grounding. So I want to come back to business planning, and you've been working on business planning, and I understand that your business plans are starting to come together, or you know, should be, or are on their way to be. And I think that that's really super important. And the value in creating a plan, the business plan, is actually the process of thinking through each business area. The value to you of that plan directly is that's because you have to look at each area of your business, you're getting a really in-depth understanding, even of the areas that you're not comfortable with, like the financial stuff. So that in itself is part of the goal, is that in doing the planning, you actually get underneath and you get your fingernails dirty, and it goes from here to here. Oops, sorry, a little more gracefully than that, but it does go from your head to your heart. The resulting plan document is actually valuable, and it's actually expected in a lot of ways as a communication tool. So your bank's going to look for, do you have a business plan? If you have an investor, they're going to look for it. So your plan as a document is a really important thing. If you end up growing to be the size where you have any kind of a staff, you're going to want them to be actually involved in the planning and then be able to hand out a business plan for the year, coming up. Each year you're going to want to tweak it, and you're going to want your staff to know what it is and be on board with it. And it's going to be a guiding thing for them. So it's a really important communication tool. So when I talk about the plan, I'm talking about a single plan. You don't have to develop 15 different plans, but you have this single plan, but it gets worked through and communicated at different levels. And I'll show you what I mean. Your business concept is your plan. I worked for the Deputy Minister of Finance one time, and he had what we called the budget on the stick. So this was the entire provincial budget on a little piece of paper like that he put on a popsicle stick and he could put in his pocket. And he wanted budget on a stick. So this is the concept, all your concept of what is important about your business. This is your elevator pitch. So it's high level, it's everything sort of you need to know to communicate really quickly. It's big concept. You want to convey the concept, spark the interest, big picture, no details, less is more. That's still your plan. That's your business plan, but it's just at a really super high level. At the next level down, you got your strategic plan. This is what is termed the 50,000 foot view. So I put a cross circle because you look at them from 50,000 feet up. It outlines your overall business goals and objectives. And this, you're talking about over the next 5 years, what are you trying to do? And you want it to articulate the strategies for how each part of the business is going to support and achieve those goals. So you've got your sales and pricing strategy, you've got a marketing strategy, you've got your production strategy, financing strategy, and IT strategy. Anybody feeling queasy at this point? Okay, that's pretty good. I'd be queasy if I were you. But anyway, when I say your production strategy, it can be as simple as, am I going to do it myself? Am I going to hire people, or am I going to outsource it? I'm talking strategy, high level, not how, what do you cut and place together and so on. Talking your strategy for how you're going to accomplish that. Your IT strategy, same thing. Are you going to, do everything yourself? Are you going to outsource that? Are you going to, run your servers here? Are you going to make sure it's that kind of stuff. It's how are you thinking of that? And your financing strategy, you're going to fund it all yourself? Are you going to sell shares? Are you going to get a loan? Or, how are you, it's the overall picture of how you're going to do that. So those are the big picture things. Many organizations are now trying to fit their strategic plan on kind of a one page with pictures and stuff like that, and sort of captions and numbers and big numbers. So it will also identify the performance indicators and the benchmarks to basically to know how you're, how do I know if I'm being successful or not? So you're going to say, well, what are the indicators? Is it sales based? Is it market share? Is it, what are the performance indicators, and what are the benchmarks that you're striving for? Do you want to capture? So if your performance indicator is, say, market share, your benchmark would be, what's the number of market share? 20%, 80%, 2,000 people, whatever it is, that's the difference between your performance indicator and your benchmark. So it's what is the number within that you're aiming to hit. So again, same plan, just described a little bit more in detail, but still very high level. Business plan is, I think, probably what you guys are working on to produce right now. And it's sort of the 3-year picture. So you take your strategic plan with all your lofty goals and you say, okay, so what does that mean? If I'm going to, over 5 years achieve this, let's break that down. What are going to be the milestones that I'm going to need to hit over the next 3 years to be on track to do that? In the first year, I'm going to get up and running and work out the kinks. In the second year, I'm going to, try and stabilize my sales in the third year, I'm going to try and increase my volumes, whatever it is, or expand my markets, or, you know, whatever your plan is. Your business plan document tends to take a 3-year piece. The first year, of course, is in more detail, and the out years are sort of get a little more vague as you go along. But you do break out your goals and your objectives into performance targets for each area. So, okay, in, you know, IT or in marketing or in sales or in finance, this is what we're going to try and hit. This is what we're going to try and accomplish. And that's going to, you know, result in these kinds of outcomes. And you're going to also try and say, you know, what kinds of initiatives and resources each of those areas is going to be. So, you know, if you're going to outsource, you're going to have really important relationships with your contracting partners. If you're going to be hiring people, you're going to have a really great HR strategy, you know, so it's depending on what you're doing. But you're gonna say, first of all, I got to hire people. Then I've got to make sure everybody is trained in my methodology. Then I'm, you know, gonna, you know, whatever you're gonna do. You want to be talking about the things in chunks, in big initiatives. Startup is in itself an initiative, a big, you know, chunk of time. The next one down, and again, I've got a picture of people meeting, because once you've finalized your business plan, you can meet with people around it. So you can talk to your banker, you can talk to your investor, you can, you know, talk to your staff, your people that you want to involve in the business, potential partners. It shows everybody that you got a clear picture, not only of what you're going to do, but you've got actually discernible chunks of how you're going to get there. It shows that you understand the business, depending on the depth that's in your business plan. Depth, I don't mean volume. It doesn't have to be really voluminous, but it has to be incisive. Then people are going to look at that and say, credibility there. Your operational plan is what I call the 1-year nitty-gritty. Very often it's a template, really. My operational plan could be a bunch of these templates. You have your first column is, you know, is it just ongoing operations, or is there a specific project that I'm trying to do this year? And typically it's a combination of those things. What are the deliverables? You know, you're going to be producing at such and such a level, or you're going to be developing, you know, in fashion, you're going to be developing 3 new lines, or whatever it is that your business is, you're going to be trying to accomplish that. That's what you have to deliver this year. Performance measures is how, like, what is going to be my performance indicator, and what is the level at which I'm going to hit there. So you're going to say, my performance measure is that I'm going to have something that sells out in the first week, or that's not a great performance measure, because it also says that you didn't do a great job of estimating need. But your performance measure could be that you've made you know, enough sales to have attracted attention and been seen as a contender in the market. Or it could be that you've taken a certain part of market share, or you could be that you've done a marketing strategy that covers a bunch of different channels. Whatever that is, you put it in, and okay, so if those are my overall things, I can't just say I'm going to do that. I have to break that down into chunks of how is that going to get done. So there's got to be a bit of a plan in place. What's my milestone? By, you know, the end of the first quarter, I'm going to have done these things. By the end of the second quarter, these things. And what are some of the activities that I'm going to do with that? Am I going to be, you know, having meetings? Am I going to be needing to purchase hardware, software? Am I going to be needing to build a network? What kinds of things am I doing there? And then you look at, in order to do that, what resources am I going to need? And so resources are the people, the technology, the services, and the tools. So have you got the software? Have you got the bodies in place? Have you got the contractual relationships? Have you got the network? Have you got what you need in place there? And then the linkages is what does this tie in with? Linkages sort of help as a flag when you're kind of doing everything yourself, but it becomes really important when you're working with other people because you need to know where the handoff point is, where I'm doing this and you're doing this, and we fit together like this, and we're not doing this and we're not doing this. So linkages are really important. And if you can capture those like in a table and then just put all the stuff that happens in a business unit, and when I talk about business unit, I'm thinking like sales, I'm thinking about how you organize, how you execute your business. You've got maybe people who deal with IT, or you put your IT hat on. And again, marketing as a business unit is how I'm thinking about that. If you go through that, you've got your nitty gritty, like you've got your schedule figured out really, and you're a long way towards going to your budget and stuff because you know exactly what you're doing and how you're going to do it and who you're going to do it with and what you're going to need to do it and what it has to tie into. So can I just do a pulse check here? Is there anybody I've lost? Is there anybody that needs me to really slow the heck down? Okay, I'm not hearing anything from anybody. Can I just get a wave of hands if you're alive? Okay, this is good. Okay, so we'll keep going. So again, same plan, different levels of detail. And this bottom one, it's for your use and your staff use and that kind of thing. It's not to take to the bank. So each of these things has a different use. One document doesn't fit all. And so you focus on the thing that you need to focus on for the job that you need to do and the people that you need to be talking to. Okay, so wait, hold on, how do budgets fit in? I'm talking all nicely about planning, but I haven't said a word about budgets. Well, maybe one or two. So again, we're coming back. The business concept, your elevator pitch, one number. So I'm going to run a $50 million business, or I'm going to run it out of my garage with 10,000 bucks. That's like all you would say in an elevator pitch. You're not showing your operational plan in there. You're high level. Strategic plan, you're going to have a handful of numbers. You're going to say over next 5 years, we're going to invest 60,000 in this state-of-the-art system, blah, 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 blah. You're going to have your high-level financial numbers, maybe some, revenues, and you're going to hit revenues of this, contribution margins of this, net income, like a big picture projections. And the goal there is to give people a sense of the scope of what you're talking about. Sometimes you need to have more numbers in a strategic plan if you are like a subsidiary or if you're trying to attract a buyer or something like that. But basically your strategic plan is big. If you're actually getting into an investor and that kind of stuff, they're going to want your business plan. They'll be fine if you have a very high level strategic plan. If you've got a business plan, they won't care if it's not in there in the strategic plan. A business plan, again, 3-year budget. So here's where you've got to have your projected financial statements. So here's where all your bits and pieces, you want to come together. You want to have an income statement, particularly an income statement, not so much a balance sheet. You probably want to have like a starting point balance sheet, but you don't need to have the balance sheet way out. But you want to have maybe your capital expenditures, your big asset spending. But you really want to have your income statement over the next few years. If you want to, you could put in your cash flow statements as well. But you actually have to have your numbers compiled, and you have to show cathartic. Generally speaking, they want to see current plus a couple of out years, and you can have less rigor in your out years, but this is where you really need to have something. Your operational plan, it's this year. You want to have solid estimates for all your revenues and your expenditures. And it will communicate expectations and boundaries. So in the operational plan, that's the thing that goes into your financial system and says, if I've got this in my budget, nobody can spend above that unless I tell them they can. So this is really thought through. This is what you need to make sure that people know if that's the revenue number, that's the revenue we're expecting you to hit, and performance is going to be tied to that. Expenditures, if you go above that, performance is going to be tied to that. If you have nobody else in your business, My own performance is tied to that. Okay, so that you really have to, that it gets more and more solid as you go down into the detail, and it gets more and more detailed as you go further down, and timelines and everything. And again, who's hearing about your operational plan? It's people inside the company. You're not showing that out to everybody else. So in the module 8, they talk about 3 different kinds of budgets, and I went, people are going to freak on that. Really, it's still part of the one budget. It's a set of financial statements. It's a set of budgets. It's really one budget, but not everything in the budget fits. You know how we talked about compiling? Not everything fits neatly into one statement. So it's only one budget, but it's where you plunk the information. So an operating budget, that's really your income statement. So it focuses on your revenues, your expenses, and your net profit. And like the income statement, it does include some non-cash items. So amortization is an example of, has anybody not heard of amortization? Okay, so amortization is if you buy a building, say, it's a big, huge thing. It doesn't, you don't push it through your income statement. You don't have to recover and make a profit, considering you've got that. You've got this big, it's called an asset, and it has future value to it. So you set it up on your balance sheet, which shows all your assets, sort of what you own and what you owe. Okay, so it's your assets and your liabilities and your equity, your piece of the company. So you've got this big, say, building on your balance sheet. Each year, you kind of use up some of the building. It gets a little older. Maybe a car is a better example. You have a car, as soon as you drive it off the lot, wham, it's depreciated, right? So the amount by which the value goes down in the year is the amount that you use in the year, and that's the amount you put through to your income statement. That's what amortization is. You amortize the asset over its useful life. Okay, so that's, and the other term for amortization is depreciation. Both of those terms get bounced around, very, very common. The module, I just want to, well, we'll come to that later. The module calls it, makes a distinction. We'll come to depreciation and amortization later. But that's an example. When you amortize something or depreciate it, it goes onto your income statement, but you haven't laid out any cash for that. You laid out the cash when you bought the asset and put it on your balance sheet. So that's called a non-cash item on your income statement. And your operating budget, you are going to want to produce that, or you're going to want to take that down to a monthly. You're going to want to budget monthly in terms of your income statement. Okay. Annually, quarterly, monthly, so that you can measure against that and how you're doing. Your capital budget is very same thing, but it's for the things that you don't push through on your income statement, for the things that you're going to have value from for years to come or periods potentially beyond this fiscal year. So that sits on your balance sheet. So you can't budget for it when you budget your income statement stuff. You have additional items that you budget in your capital budget. And they're called expenditures because an expense is something that goes on your income statement. An expenditure is an outflowing of money, but not necessarily the one that shows up on your income statement. So capital budget is usually a multi-year budget because if you've got equipment and whatnot, you got to look at how old your equipment is. Maybe you want to have like a 10-year capital budget, and you know that maybe every 3 years you want to buy a computer, but maybe only 10 years do you want to replace, 10 or 20 years you want to replace a sewing machine. So you have this budget in there, and you want to make sure that by the time you get to needing to buy that, you've saved up the money for it, but you want to make sure that you're tracking essentially your capital equipment. The current year requirements for what you're going to spend on your assets and also on your capital budget and your operating budget, they're going to get reflected in your cash flow budget, which is the next thing we're going to talk about. So the cash flow budget takes these things that go onto the income statement and the balance sheet that represent actual sources and uses of money that you're actually going to pay for in the year. And so you don't put things like amortization on it, you put the actual cash flow on it. And you're going to want to do a cash flow budget for the year, but you definitely want to do that monthly. Some places need to do it more often, depending on your business. I think starting out, you're probably looking monthly and then tweak it from there, but you definitely want it monthly. And what basically it shows, your opening balance, all the money's coming in, all the money's going out, and then your, change in the month, that plus your opening balance gives you your closing balance. So this is something that's mathematically going to work. And then that's the opening balance for the next month, and then you do the same thing. So the big difference between the cash flow budget and your income statement items is the timing of when you pay for stuff and when you receive money. So if you tend to pay for things as like you get something, you pay for it immediately, and when you sell something, you get the money immediately, your cash flow budget's going to be, in a lot of ways, very, very similar to your income statement. If, however, you maybe are doing, say you're making furniture, and you make custom furniture and you don't make a piece until somebody orders it, there's going to be a difference between when you initially make the sale and when you probably get the money, because the time that it's involved in making it, you might get a deposit, but you won't get the balance and so on. So are those three budget, sort of thinking about budgets on three different statements, does that make sense to people? Anybody it doesn't make sense to? Anybody still confused by this?
Okay, so I understand the three budgets.
Uh-huh.
I'm getting a little confused because I'm photography, videography, and live broadcasting services.
Uh-huh.
And so we have like retainers, and then sometimes our services aren't provided for like a month or two,
Yep.
or like even a year if we do like a wedding, that kind of thing. So I know that in my business plan last semester, we talked about like you don't actually put in that income until the services are provided. So I'm not sure where I would place that in.
Okay, so if that's what you're talking about, and you may not realize you're being quite this savvy, is you're talking about your revenue recognition policy, and good for you. So what you're saying is you're not going to actually recognize that revenue till you've earned it. That's good. So you've actually gone a long way to aligning your income statement to your cash flow, because you're not going to recognize it till you've earned it, and presumably once you earn it, you get paid. The one thing that's going to be different is your deposits. So what you're going to do is you're going to have most of your revenue in the same month that you're going to forecast it for your income statement, but you're going to move forward. You're going to have your deposits sitting on your cash flow statement just a little bit earlier. Does that make sense to you?
A little bit.
Okay, so the portion that you get as a deposit, you're going
Okay.
to slap down on your cash flow budget in the month that you actually receive that deposit.
Okay.
You're going to put all of your income related to that. You would otherwise budget in the month that you earn, that you do the job and that they pay you, right?
So I'm going to have like future months, like years in advance. Is that what you're saying? Sorry, that's where I think I'm
Yeah, like if it's all going to happen within the same year, then
Sometimes it happens like the next year.
yeah, if it happens in the next year, then yes, that's true. So you'll have your deposit showing a deposit. It's a asset on your balance sheet. It's not actually a revenue yet because you haven't earned it.
Gotcha. Okay.
But you've got the money, so it's sitting in your bank account, or you can say it's a deposit. And then
Makes sense.
you're gonna recognize that revenue in the next year. So the next year, you're gonna show 100% of the revenue. And say you get a 10% deposit, probably way too small, but say you get a 10% deposit. You're gonna show 10% of your fee on your cash flow statement this year. And you're gonna show it on your balance sheet as a deposit, and it's in your bank account. You know, that's the two sides of that entry. Next year, you're forecasting that you're going to have 90% of that revenue, okay? And when you, 90% of the money coming in on your cash flow, you're going to get the other 90%. But next year, you're going to have 100% of the revenue coming in.
Okay, that makes sense. Okay, I'm with you now. Thank you.
Okay. So that's a really great example of the timing difference. So the main difference between your income statement, if you do your income statement by month and if you do your cash flow by month, it's timing. When are you getting the money versus when is it hitting your income statement? That's a really great example. Thank you, Tracy. Okay, so coming back to this, I just want to recap, and where are we at? We're about 1:45. That's what I wanted to talk about in terms of planning, the planning cycle, and the planning part of that cycle. Now, in a business cycle, you plan, you transact, and you record. Transacting means just doing your business, and you record all of those transactions. Then you report and you monitor. So you get reports. If you've got a financial system, even if it's like QuickBooks, it generates reports and you look at those reports every month. We'll talk more about this. And you know, I don't actually expect you to get quite as excited about your monthly reports as I do, but eventually you will, honest. And then you need to evaluate and then work that into your next year's plan. So again, we've just focused on the planning part of this. So we're now going to start to talk about profitability and get back to what's in the module here. Who needs a break? Anybody just need to give your head a shake or need a comfort break or anything? We're doing okay? I see a couple of heads doing this. So are you okay we'll keep going? Okay. So profitability, according to Module 8, and I don't disagree, it's impacted by sales, how much those sales cost directly, like what do you put into those sales, your operating expenses, which are your indirect expenses, and then other revenues. Like hopefully you make so much money that you've got stuff in the bank for enough time that you're earning interest on it, and you know that's another revenue. So my question back to you guys is, do taxes affect profitability? I want to show of hands. Yes, they do. That's a sure. No, they don't. Okay, so the answer to this one is, it's not really clear cut. You're not going to be right or wrong. Taxes do not affect profitability on your income statement. So what you do is you figure out how profitable you are, and you only pay taxes if you actually have revenues more than your expenses. So if you're losing money, you're not paying taxes, conceptually, right? So no, they don't actually affect your profit, but what they do affect is your goals and your targets. So when you're planning for profit, like it doesn't affect profitability. You don't go broke paying your taxes. You don't not have enough revenues to cover your expenses because you're paying taxes. It affects profitability in that you have to figure out, if I want to make 100,000 a year, I have to pay tax on that 100,000. So I have to plan maybe to make 200,000 a year so that I can live after tax. But I'm not gonna be more in the hole if I just break even on my venture because I'm not paying tax for that. Does that make sense to people? So you want to factor in things like paying yourself in the salary kind of thinking, because if you're paying a salary and that's part of what it's covering, you're not paying taxes on that. You're still getting money from a salary. We'll talk a little, we have a slide on how you get money out of your company, but just think about that, is that taxes are after you've actually, your revenue exceeds your expenses. So that's a little bit of good news. I mean, it affects profitability because you have your after-tax profits and your before-tax profits. But if you don't have any profits, there's no tax. So then the question is, if those are the things that impact profitability and you want to plan to have a profitable company, how do I accurately project sales, cost of goods sold, and operating expenses? And this is the part where your eyes can start to glaze over and think, I don't know, I'm not a numbers person. But we're going to go through this. We're going to go into it, the details of this. I have to say, if you want to be successful at any of this stuff, you have to write things down. You have to document your assumptions and your data sources. I am like very retentive accountant. If I find that I've forgotten to write something down, 2 days later, I'm kicking myself because I can't remember how I came up with that number. And I'm a numbers person. So you really will thank yourself if you try to remember how you got that number. So it's as simple as, 2 widgets a day times 4 days a week times 20 weeks a year. Like that's all you need to put. Like for every number that you have in your calculations, put a little 1 beside it or 2 or an A or a B, and then down below put that 1 or 2, and then just write, how did you come up with that? When you're putting something into an Excel spreadsheet, don't put the answers 20, put 1 times 2 times, whatever, times 5 times 2, like put how you got that so that you can, okay, well, what was a 1 and what was a 2? And you want to make sure that you know that. Put the formulas in, make use of that Excel functionality. So one is when you're planning, and particularly as an entrepreneur, you're doing startup stuff. So stuff's changing all the time, and your idea and your scope and this and that, everything's changing. And last week I was thinking about doing this. I realized, no, I got to completely rethink that. You have to keep track of what you're doing. So I'm going to like pound away, the document your assumptions and your data sources is for your own benefit. In addition, doing so is going to give you a lot more credibility. So if you present something that your cash flow sheet and you're trying to get feedback on it, or you're showing that to your banker or whatever, and you've got all these footnotes that, just sort of 1 per number or whatever, and they can, oh, okay, yeah, you've actually thought about this. You didn't pull that number out of the sky. The other thing it does is when you're asking people for feedback, which I hope you're doing, I hope you've got good mentors and good colleagues that you can just, and of course each other, that you say, I'm trying to get some feedback on this. What do you think? Are my numbers high? Are they low? You're not trying to get them to tell you whether you've calculated the number right. You're trying to get them to talk to you about what assumptions you've made. And if you've got them all documented there, is 50 weeks a year right? Should it be more like 30 weeks a year? Is my number high? What other things am I not factoring in there? Those are the reasons why you really want to make sure, especially as you're getting going, you capture all that information. So looking at your sales projections, some common approaches, and they talk about this in the module. The 3 ones that they talk about are comparative sales. So looking at what everybody else is doing. Average sales is saying, I kind of know how many will sell and what the selling price will be. So I'm going to calculate that. So on average, I'm going to sell this much and it's going to cost that much. And here's my sales numbers. And then there's the bottom up approach. And this this is the one where I haven't a clue. I don't know how many of these are going to sell. I don't know, but let's just figure out if I'm going to be successful, and I know it's going to cost me all this to do this. This is what I'm going to have to make to be successful, and then kind of work backwards and pull that apart and say, is that doable? So when you're thinking about sales projections, do not forget to factor in, oh, I had a typo there, I'm terribly sorry. Don't forget to factor in commissions, discounts, and returns, because they're going to come off your sales numbers, right? Like they're not going to go at all. You get these revenues, but they're not at all going towards counting to covering your expenses, right? So don't forget to not just do gross sales in your sales projections, but think about what is the net sale money that you're going to get from there. So hopefully you're going to look at sort of more than one of these approaches, and they're good tests against each other to see if you've got a good reasonability. On the comparative sales one, you're looking at how are others doing. And so you're looking at individual competitors because you want to compare apples to apples. And you want to think about, like, I went through fashion design. What are my classmates doing in terms of how much they're charging for stuff, hourly rates, or, to put in a zipper or whatever. Also, if you've got a good network, if you belong to some sort of industry group, this Leap In group can really help. They might not do the same thing you do, but I was amazed. My group was, I thought, very disparate, and I started out thinking I have very little in common with these people, and it was wonderful how much I actually benefited from my group and their knowledge and what they were doing, and just soaking all that up. And industry norms, if you can get industry data, that's really good. I find myself that comparative sales works really great if you have relevant experience. So if you've got a family business that you're continuing on or taking in a different direction, if you've had extensive prior experience. So I'm not talking about you worked in a store and all you did was sales. I'm talking about, did you do receiving the goods? Did you do some of the accounting? Did you work on some of the marketing stuff? Like if you've had extensive sales, then that can help you think about comparative approach. If you have helpful mentors, that's gold. If they're willing to share with you that kind of stuff. Otherwise, I find relevant comparative sales information is really hard to get. So I have a question. What do you call a business that does exactly what you do? Anybody know?
Your competition?
Exactly. And is your competition going to tell you how they figure out their sales? I don't think so. So I think this is really hard information to get. Has anybody been doing well on getting comparative sales information? Yeah, it's hard, isn't it? Like it's a tough one. I don't say that to say don't try. Always keep your eye out to see if there's some way you can get that. I'm just saying this can be tough. Average sales in the bottom-up approach. The average sales works well if you've got a good handle on your pricing and the demand in your market, which actually you should, because if you're going into the market, you need to know, is there room for you? Oh, my computer is telling me my battery's running. Well, I guess I got unplugged, sorry. So if you should be knowing you're going into that market. You should be at this point getting a sense and a feel for that. But what's important to do here is consider your sales mix. So that's a term. And that means how many of each product you're making and at each price point, because, 500 of these at $2 and, 400 of these at $6, very different. And maybe you've got a big ticket item that you're only going to sell 2 of, but you want to throw that in there too. The bottom-up approach, you want to decide, you have to decide on your profit target, again, factoring in that you're going to have to pay tax when you're really successful. Then you want to add back in your operating expenses. You want to figure out what your contribution margin is going to be. We'll talk a little bit about that again. And then you work backwards to back into the, so you basically take what you want to make and you add all your costs on top of that and you keep adding to it. And then you come up with what your revenue stream has to be. So if possible, you want to test the 3 approaches against each other for reasonability. You want to do a high, medium, and low, which is better termed optimistic, realistic, pessimistic. Use those terms, you impress more people. And the bank and the investor will love you, especially if you can say what is going to impact whether you're going to achieve optimistic, realistic, or pessimistic. So if you can say, these are my 3 scenarios, and optimistic is if we time this right and we get everything right at the beginning of the season, I really think we can hit these optimistic marks. If the weather is great all summer, that's what would allow us to do this. But if we have, another COVID, or if we have like a hurricane season, where it's setting records or heat waves or whatever it is, that's when we're going to run into the pessimism. If you understand what your drivers are for your sales and how things fall together that way, and you can talk about that in maybe your business plan and talk about high, medium, low, that will really help people think you do understand your business well. And I'm not talking go on for pages, I'm talking about a couple of sentences. So you want to, as you're doing your sales projections, think of what is the basis of your fee? Are you going by units of time? Are you going by number of widgets that you're making? Are you going by gallons of something? What is it that you're going by? And so you want to think about what is your unit? You want to think about what's going to limit my sales. Is it going to be, there's only so many customers, there's only so much customer interest. Is it going to be, as soon as I set foot in this market, my competition is going to go after me? Is it, I could sell all that I want to, but I only have so much production capacity? Is it once I've made the sale, now I have to, scramble, it's going to take me 2 months. I need some lead time in there. Is it going to be my product life cycle? I could make 100,000 of them, but this is a trendy thing and I can only sell 50,000 this year, so I can't sell them next year. Think very much about your sales cycles, your seasonality. Does your sales volume vary by hour, by day, by month, by season, by temperature, by economy? What kinds of things drive your sales? And then that's going to work into not only your total sales, but also your cash flow projections. What periods are you what months are you making more of your revenue in? What are lower months? What are higher months if it's cyclical? And again, what we were talking about on the other page, think about your gross versus your net sales. Make sure you're factoring in returns, discounts. If you're having a sale, how many times you're going to have a sale every year? Commissions, payment processing fees like PayPal and credit card fees. Factor those in because they come off right off your sales. How are we doing? Are people wanting to hang in, or are you like, there's 2 approaches to this. I need a break, or I want this to be over as fast as possible. So how are you doing? You guys are okay. I see 1 thumbs up. Okay, I see a thumb up here. Okay, great. Okay, so I'll keep going. Projecting inventory and cost of goods sold. So can anybody tell me what is the difference between inventory and cost of goods sold from a financial perspective?
Anyone want to take a guess?
So I feel like that would be for me, like if I were to do prints. So like my inventory would be like my printing paper and like my canvas stuff. And then like the cost of goods sold, like the cost of a print is higher than the inventory for me to make it. So like the difference between the two would be my profit. I don't know, maybe that's wrong, but
You're getting there. It's not quite that, but you're getting to the right kind of thinking. And I think what we're going to go through is going to clarify. And I think maybe even actually when we're finished this slide, you're going to have it. The difference between inventory, the term inventory, and the term cost of goods sold is Only difference is whether you've sold it or not. So it moves from being inventory on your balance sheet to being a cost of goods sold on your income statement once your sale has happened. So it's exactly the same thing. You don't, like when it's a finished good, you don't add anything more to it before you flip it over. So it's inventory until you sell it, and then it's cost of goods sold. So inventory has a few phases, and not all apply to every business. So does anyone here sell products or resell or make products? Okay, yep, okay, good. So anybody just sell services? Okay, so you are really lucky. A lot of this you're not going to have to struggle with. So that's good for you on that score, but that's going to be easier for you. But if you are selling something or reselling something or making something, and actually I'm going to come back and say you might actually have an issue if you sell services. When you sell a product and you have inventory, what it is, the phases are, first of all, you buy raw materials. You buy, your example, fabric. You buy thread. You buy, packaging materials. You buy all the components that go into making that. If you buy, if you're running an antique dealership, you buy a chair. That's your inventory. You're holding it until somebody buys it. Work in progress is all the things that you have to add to it in order to make it saleable. So work in progress could be your labor. You would add your labor costs to it. So those are all the costs. So as it goes through the phases where you're doing more to it, then you're adding costs to it. And then at the end, before you've sold it, it's in finished goods. I don't have to do anything more to that, but hand it over. So that's a finished good, but it's still sitting in inventory because I haven't sold it yet. Moment I sell it, boom, it goes out of finished goods and becomes a cost of goods sold. The one exception that I'm saying for if you have a service is if your services are that you're maybe writing a report, then you do have to pay a little bit attention to work in progress because you will spend hours and hours and hours on that report, and you'll have drafts and whatnot. And the hours that you spend really do start to come into inventory, which is, we'll talk about that a little bit later. But this is just, it moves through. You buy the raw materials, you add to it with your labor, and maybe there's some supervisory, and you've got hydro and production costs, and maybe other raw materials at different stages. Then you create a finished good. It sits there in inventory, and then once it's sold, it gets moved over to cost of goods sold. The little balloon on that, really, this is the one that you want to have in the corner of your wall, a baseball bat, and get out and you want to whack these, because this is the most important type of cost to keep an eye on. They just itch to get out of control. You need to be completely on top of your inventory. So I'm going to pick on the fashion design. I know we've got a couple of fashion design people. Who's the fashion design people here? Okay,
Cecilia.
Okay. Do you have a fabric stash? Cecilia?
Sorry, do I have what?
Do you have a fabric stash?
Yes.
Okay. Okay. And do you have plans for every piece of fabric in your fabric stash?
No.
Do you have some fabric that perhaps you just love?
Yep.
And that's why it's in your fabric stash?
Yes.
Okay, this is exactly what I'm talking about when I say we have to be careful of our inventory. So I'm not just going to put you on a spot, Cecilia. I have to confess, and I told this to Dave when we were going over the notes yesterday. I have a fashion-related business, and before I even started the business, I thought, oh well, what do I have in my little fabric stash? I went dumpster diving at Fabricland because the Fabricland that was near me has this big, literally a dumpster out the back, and the only thing they put in their dumpster is cardboard, so it's nice and clean. I went dumpster diving for those, pieces of cardboard that you wrap the fabric around so that I could wrap all my fabric around it and then put them neatly on shelves because as you probably observed, I'm quite retentive. I started out with more than 200. I just love fabric. Okay, that's fine when it's my hobby. As a business, that will put you under. So this is what we were talking about, is that like inventory is the thing that, you just love, and it's so exciting because you're going to make all these things with it. And then, time goes by and you realize, oh, it's an issue. So anyway, again, talking about inventory, what costs do you include in your inventory? So here's where the CRA pipes up. Now, CRA is the Canada Revenue Agency tax man, and they have actual rules for what you need to include in inventory. And if anybody really is interested in that, I have like a one-pager from CRA that I can give you that actually you can make sense of. So their list is pretty similar. So you have to include your raw materials, packaging materials and supplies, work in progress, and finished goods. So the laid down cost of materials of what you paid for. It includes customs, duties, transportation, all your delivery costs, acquisition costs. If you have to store it, the storage costs, the insurance on your production facilities, all of that gets put into inventory first, and it sits on your balance sheet. As you're spending that money, it sits on your balance sheet because you haven't yet sold. Then you start to add to it the direct labor. So as you're paying somebody to sew, or you're paying for somebody to refinish the antique furniture or whatever, all of that money goes into inventory, not onto your income statement. It's not an expense yet. If you goof up and you have to rework the product to make it saleable, that time goes into inventory, and an applicable share of the production overhead. So if you've got, supervisors or utility costs or anything that's actually related to producing or keeping and storing and that kind of stuff, all of that is part of your inventory costs. And then CRA says you actually have to take a physical inventory on the last day of your fiscal year. So that's how you know the volume of your inventory. So you're tracking your cost of your inventory, and all these things keep getting added in. And then you count how much you have in inventory at the end. And then we'll talk a little bit about what to do with that. But these are the rules according to the CRA. Now, you've got all this stuff, you figure out, I've sold some stuff, I've got some stuff sitting in inventory. How do I say how much is in that cost versus how much in this cost? And there's some ways, there's different ways of valuing your inventory. These are called inventory valuation methods. And it depends a little bit on your business, which is the right one. Well, it depends completely on your business, which is the right one for you. And there's some flexibility. The CRA will allow you to choose the one that's most appropriate for your business. But you have to be consistent. You can't do one year and one the next year. The specific item is back to our example of if you have an antique dealership. You buy a table, you sell that table. It's very specific. It's specific item by specific item. You can recognize, that's the item that you brought in inventory, and that's the item that you sold. It's better for a smaller business that has unique, discrete products. Average cost, or weighted average, is you take all the things of inventory that you've bought during the year that are the same, and you divide by all the number of units, and the total cost divided by the total number of units gives you the average cost. And however many widgets you have in your inventory count, that's how you value your inventory at the end of the year, and the rest goes into cost of goods sold. Okay. First in, first out is more of a batch type of approach. So you might buy things in batch. So you might, buy a shipment of fabric. And so you know that this shipment comes in and it's sitting there, and then you're buying, then you're making stuff, and you know you've ordered 10 yards, and you're making 8 yards. You're using 8 yards in production, so you know that 8 yards came from the 10-yard bolt that you bought, and you carry it through. You can track sort of how much you've bought of a particular thing. And, you know, it doesn't matter what, like if you bought 3 bolts of fabric that's exactly the same, you don't care which bolt it came from, but you know it's that chunk of bolts, that batch of bolts. So what you assume then is the first thing you bought is the first thing that you use, and it's the first thing to go out the door. First in, first out. So it's called FIFO. And so that's how you value your inventory. So if you started the year with, you know, 20 yards of something, and you bought another 100 yards of something, and then you finish the year with 30 yards of something, then you know that you, if you finish the year with 30 yards, you know that you have sold all but the 30 yards. So you've sold the initial 20, and the next, did I say 100? So you've sold 120. You know that because you've sold 120, that first in, that 20 yards at the beginning, you've sold all of that. So you know 20 yards, your opening inventory is at what you paid for it. And then the other amount, which is another, 90 yards that you sold, you value it at what you paid for it during the year. So the first amount, you say those 20 yards were at this price, the next batch was at this price, the next batch was at this price. And then those add up to be what your cost of goods sold is. And you know that the last 30 yards that you bought is the value of your inventory at the end of the year. Okay. The retail method, is where you're like running a store and you've got hundreds of thousands of items. And really the CRA only allows it for this kind of an operation. And what you do is you figure out on each type of product what your markup is, and you value it kind of that way. It's sort of like the bottom-up approach to sales forecasting. Okay. I would say probably most of you that have inventory are going to be specific item, average cost, or first in, first out. And that's something to think about, because once you figure that out, what you figure, you know, what mirrors your buying patterns and your tracking patterns is going to probably be the approach that you take. And then get to know that approach. Don't worry about all the other kinds of approaches. So look at this a little bit, think about how does my inventory go? And then if you need some help on that, I'm happy to talk about it with you later. The inventory, I would say, is the trickiest part of the bookkeeping stuff, and the accounting and the forecasting and that kind of stuff. But it's also really, really important to track, because it's really possible to buy way too much or let your costs creep up. So getting into projecting your operating expenses, when we talked about the cost of sales, we talked about all the ones that were directly relevant to everything that you're producing. Your operating expenses are less relevant to the specific thing that you're buying. If you have a company, you're going to have accounting, you're going to have legal, you're going to have office rent or utilities in general. It doesn't matter what you're selling, what you're producing, you're going to, keeping the lights on kind of thing. So these are less direct. They're non-cost of goods sold expenses. And if you get to any size where you're going to have financial statements that have to follow, generally accepted accounting stuff, you're going to have to track your amortization and interest, and disclose it separately on your statements, have a separate line for them, but you're going to calculate them separately anyway, because they don't look like anything else. So that won't be a problem. We're going to come back to the amortization discussion. So again, we talked about how amortization is expensing the depreciable base over the number of useful years. So I'm calling N number of useful years. So the depreciable base is what you paid for the thing, including what you paid to have it installed, less what you think you might get for it when you're finished with it. So if you think you bought a car and you might sell it at the end for $1,000, you would, and you paid say $20,000 for the car, your depreciable base is the $20,000 less the $1,000 you might get for it when you sell it secondhand. It's $19,000. Okay. There are 4 approaches here to the amortization method. And actually, I should just mention, in Module 8, they explain that depreciation is for tangible capital assets. So it's for your car, your building, your equipment, the things that you buy that you can touch and feel. And amortization is the term used for the intangible things like your trademark or those goodwill or those kinds of things that you might buy if you buy a business. There was some accounting changes a while back, and actually in Canada, it's now all called amortization, but the term depreciation is still very much around. So just want to clarify that the technically right term is amortization for financial stuff, but depreciation, people might understand that more clearly. Straight line, declining balance, which is also called double declining balance. We'll talk a little bit about why. Some of the year's digits, which is kind of a odd thing when you think about it. Units of production. Those are the different amortization methods. The CRA, like when you do your tax returns for you personally, if you've got a sole proprietorship, you can amortize the assets that you're using for your business and claim depreciate or amortization from the CRA. CRA calls it capital cost allowance. That's their term for amortization or depreciation. And they use declining balance for most capital expenditures, straight line for a few, and you'll see why. The other thing I want to point out is if you in your financing decisions, you're saying, oh, gee, should I buy the computer or lease it? For purposes of like your income statement and your financial stuff, if you are leasing an asset for at least 3/4 of its life, so computer, if you're leasing a computer for 3 years, that's most of the life of the computer these days. So the accepted accounting treatment is to basically pretend you bought it. You bought it outright, put it on your balance sheet, and then amortize it over time and put it on your balance sheet as your asset against a capital lease liability. And so for the purposes of that, you need to think about your leased assets in terms of amortization as well. I apologize for this slide. You're probably going to want to write a note about which color means what if it's not clear. I pulled this slide off. I've given it credit, but the one thing I don't like about it is that there's 4 lines and there's 4 colors, but they just look like 2 colors. So I am sorry about that. Straight line is the one that goes straight across, surprisingly, and it's evenly amortized over time. You take the useful life, you divide it by, you take the cost, the depreciable cost, you divide it by how many years you're going to have it, or you think it's going to be useful rather, and that's the amount that you amortize each year. So not surprisingly, it's the straight line beside the number 3,000. Declining balance, it's also sometimes called double declining balance. And the reason is you depreciate or you amortize a certain percent each year. And it's kind of like when you drive a car off a sales lot. Like as soon as you drive it off the lot, boom, it's down like 30%. You can't sell it for the same amount again. Once you've like gone off the lot, it's toast. And it depreciates the most at the very beginning. It's the biggest whack right then. And then as time goes by, it becomes worthless more slowly. But that big hit is upfront. And so the way you arrive at the percentage that you depreciate by every year is you take the estimated life and you divide it in two and have that as your number that you know, 1 over that number is the percentage that you take. So if you think the thing's going to last 8 years, you divide 8 by 2, and that's 4 years. And then 1 over 4 is 25%. So each year you're going to pay 25% to the balance that's remaining. And that's how much your asset goes down by each year. That's how much you put into your income statement each year. And so you're going to find that the amount, say you've got a $10,000 asset. The first year it's 25% of that, it's 2,500. The next year you're taking 25%, not of 10,000, you're taking 25% of 7,500. So the next year, the amount of amortization is smaller. And that's what's reflected in the curve that has more of a dip in it. So it's the orange one that starts higher and has more of a curve. That's the declining balance. And the reason they call it double declining balance is you divide the estimated life in 2 and it's sort of a higher percentage. The sum of the year's digits also achieves a higher expense in the early years. And so essentially what you do is you divide it by, you know, how many years you're using, what year you're in, divided by the sum of how many years there are left. So in the first year, you would amortize 1 over, if you're having it for 5 years, you divide it by 1 over, you have 4 years left. So hang on, have I got this, did I put this in right? Yes, you have 4 years left. So you amortize, you divide 4 divided by 1 plus 2 plus 3 plus 4 plus 5. The remaining number of years at the beginning of your year. It's a bizarre kind of thing, but it seems to work in a very straight way to show you're depreciating or you're amortizing more at the beginning of the thing than you are at the end of its life. And you will actually get down to a 0. You'll notice with the declining balance, because you're only taking a percentage each time, until you get down to like less than $1, you still always have a balance left. That's why the straight line is coming down a little bit lower than the curve. It's because, you know, you're always taking percentage of a number. Units of production also makes a lot of sense if you know how many units your asset will produce. So if, for example, you buy a printer and you know that that printer will produce, you know, 3 million copies over its life, you can track how many copies you use during the year and say that over the total number of copies it will do in its life is actually what I've used this year and therefore what I should expense. So you'll see that the units of production is the blue jagged one that goes all over the place because each year you might be using a different amount. It's based on your actual activity. So that's sort of a run through of all the different amortization methods. Are you guys still with me? This is like such dry stuff. I do apologize for that, but are you guys able to relate this at all to your business? Are you able to relate it to the assets that you have, the kind of sales you have, the kind of inventory you have? So that, like, the key here is I'm not trying to get you to become accounting experts and know all the different ways that you can amortize. I want you to think about which is a way that fits my business. I'll go with that. And that's really all, like, what you want to be. So try and think of it that way so that when you come to do your business plan, your budgets and whatnot, you're kind of well informed about what your options are and you choose the one that fits you the best. Okay. Did you want to give everybody a bit of time to, like, how are people doing? You don't need to, like,
We don't need to run a marathon, guys. If you want to take a little break, we're happy to provide one.
I think maybe a stretch break would be a good idea. Maybe get
Yeah.
the blood flowing out of your brains and into your limbs a little bit.
Yeah, so just on this slide, be reassured. We've gone through the research because you were doing that in your earlier work. We've talked about budgets, that these are the things that you want to be compiling. And in terms of planning, we've talked about all those kinds of things that you want to plan for. The assess and adjust we'll come back to, but we're going to move on to transact and record because we want to get through not just how to plan for a business, but how to actually have a profitable business. And so we've come through the planning part, and that's the biggest part of the presentation, I think. So just know we've gone through like what I think is the hard slogging, talking about how to project all these numbers. And the exercises that are associated this, that Dave's going to talk about a little bit more, will get you actually putting your own numbers into essentially the income statement, the cash flow statement, and so on. We've got some templates for you and that kind of thing. But just be encouraged. We're actually moving through it.
Okay, team. I want everyone to stand up and touch your toes if you are able. You may do that with your cameras off and come back at, what do we want? 5-10 minutes? Split it at 5 minutes. All right, come back at 2:35. Thank you, Steve. Excellent. Well done. Snaps for Steve. And come back at 2:35 and we'll jump back into our time with Kelly.
Okay, thank you. I myself am getting another cup of tea.
I believe I shall join you, Kelly.
Oh my goodness. What are you?
How are we doing?
I'm doing good. How are you?
I'm doing good. The one thing I just want to come back to in terms of the inventory valuation methods is, inventory stuff to include in inventory is if you are a consultant and you're working on a report, the CRA does actually require you to have a work in progress. So it does require that you take the value of the hours that you've put into doing your, like if you've been paying people and they're working on the report and that kind of stuff, or your salary or whatever, to a report and it's only half finished, the CRA requires that you count that as work in process inventory at the end of your year, unfortunately. Used to have some wiggle room on that, but now you kind of have to do that. So if that's your business where you're doing that kind of consulting and you're in the middle of a project and you've had some costs related to that, direct costs related to that, you'll just want to know that in the back of your head. Again, the concepts that I'm talking about for you guys, I'm not trying to get you to pass an exam on accounting. Think about, did that just apply to me in my business circumstances or not? And if it does, you know, make a note of it and follow up on it if you want. I'm happy to chat a little bit further, but if it doesn't, just let it go because you don't want it clogging up your brain. Okay, so we're back to here. Okay, so we're gonna go now, the blue thing has changed to transact and record. So how do I use financial concepts to assess and monitor profitability? And in terms of transacting and recording, I'm saying, unless you have reliable information on your actual activities, you cannot assess and monitor profitability. It's not possible to do it. So in order to be able to assess and monitor your profitability, you have to capture your information. You have to record your transactions. You have to keep, basically you have to keep your records. So this is not officially covered in your modules, but it's super important. And it is the piece that I think gets missed the most by entrepreneurs who don't have a business background. So a lot of people, and I think it's a little bit generational. Like for me, part of growing up was learning to, you know, bookkeep and keep records and stuff like that. But today, everything is, you know, internet, phones. You know, we didn't have computers when I was a kid. So I get something, we didn't have banking machines even. So, you know, you went and you've got your passport, you put it in the bank and you had a record of everything and everything had a record. And you got receipts for everything. And now you go and you buy something and they say you want a receipt. And most of the people I see say, nah, I don't want that paper. I don't want that paper. This is a really important part of business. And I'm really sorry, but it's important and it is, you got to do it. And I'll help you think of some ways of doing it simply, making it easy, making it not a big deal, but it is important. So you have to record stuff. You have to document stuff. You have to have backup for stuff. And we'll talk a little bit about that. So I'm saying, unless you have reliable information about your actual activities, you can't assess your profitability. And so what do I mean by reliable information? It's timely. You don't wait 2 months to record something. It's accurate. So it's not sort of this amount. It's actually, you did a transaction, money changed hands. What is the actual amount of that money? It's complete. You don't sort of forget about recording some of the sales because they were just cash. Fastest way to get yourself into trouble. And you get into trouble from a number of perspectives. The CRA will figure it out eventually. And you won't remember it. And you won't actually have a true picture of what your business is doing. So complete is important. Consistent's important, that the way that you track something, we talked about inventory valuation methods, we talked about amortization. The way you pick to do something, you do it the same way each year. It doesn't mean you can't change approaches. It means you don't go wishy-washy. Like if your circumstances change, and that means that a different way is now more appropriate because your circumstances have changed, sure, you can change, but presumably you're not being blown around by the wind and needing to change every year. So you want to deal with things consistently, so you're comparing apples to apples over time. And the last thing is verifiable. So this is where your receipts come in. If you make a sale, you want to have an invoice. If you buy something, you want to have the invoice that they're giving you and a receipt, like some way of showing that you've paid for it. Because being able to claim something as an expense with CRA is dependent on it. They can just decide to disallow things because you don't have a receipt. And so we'll talk about that later on, but that's really important. So when it comes to anything to do with your business, if somebody offers you a receipt, say yes. And if they don't, say, I need a receipt. And we'll talk a little bit about it. You can tell I'm so stressed about that, thinking about not getting a receipt. Anyway, it is important, and I'll talk more about that. So transact and record. So bookkeeping, why bother? So why bother tracking is it helps you know how much you've earned or lost, how much you own, how much you owe, and how much you are owed. Too much to keep in your head. I'm a numbers person. I can't keep it all in my head. You need it in order to track against your plan. That's hugely important. One, you want to keep out of trouble, but two, you want to actually know if what you're doing makes sense in terms of what you were hoping to do and what you were planning to do and what you were needing to do. It gives you a clear picture of where your money's coming from and going to. You got this plan, but is that actually what's happening? He's going to laugh. Bank reconciliations help you figure out if you're missing money or you're understating revenues or costs. I'm going to keep going at you on bank reconciliations. Is there anybody here who's never done a bank reconciliation? And that's totally what I would expect. But you need to learn how to do a bank reconciliation, and you need to reconcile your bank account monthly. And we'll talk more about why later. This is the one thing that will immediately help you figure out if your money's drifting off somewhere where it shouldn't be. Okay, and this is a really important control. It can help you get and keep a business loan, and it supports tax reporting. So it helps you stay out of trouble, and it helps you avoid paying either unnecessary tax as well as penalties and interest. If you don't file your tax on time, then because you haven't done your bookkeeping, so you can't figure out how much tax you owe, when you finally get around to it, you'll owe the tax, you'll owe a penalty because you didn't pay on time, and then you'll owe interest on all of that from the time that it was originally supposed to be filed. It also, your bookkeeping will help you figure out how you're doing in your business, and therefore how much you're tracking to make over the year, and therefore how much tax you're going to have to pay. So therefore, get that money ready to pay. So bookkeeping basics, make sure you get receipts for everything. You may have heard me say that. Separate your business from your personal expenses. You want to keep separate records of that, even if you're a sole proprietor. And it doesn't have to be that you have to make two different actual transactions. You just have to be able to record it separately. So if you buy one thing, maybe your phone is an example, you use it partly for business and partly for personal, you can allocate, your monthly bill, X% to personal, X% to business. That's how you separate something that you actually use intertwinably. Is you get the bill and you make a rule and you say phone is always this percentage. You want to choose a bookkeeping system. It doesn't have to be a fancy, expensive one. I'll talk to you about QuickBooks later. We'll talk about QuickBooks later, and it's one that a lot of people would have heard of. You want to categorize your transactions. Am I doing, sales type of transactions? Am I buying inventory type stuff? Am I paying, utility bills? You want to organize and store your documents. So this can be organize them in, I'll show you a little thing I have. I've got something like that. Okay, it's got 12 little slots. You can just stick things in each month. And then, at the end of the month, record them. It doesn't have to be fancy. You can literally put it in a shoebox. And that's where they talk about, shoebox. And if you really are getting somebody to help you, you can put it all in a shoebox and then give that to somebody. If you faithfully put everything related to your business in that shoebox, that's great. They'll love you. Well, they'd love you more if you organized it a bit, but they will still love you. That's the completeness thing. They need to have all the records. Reconcile your bank account monthly. I'll come back to this again and again. And the other thing is you need to know what numbers you need to know. So parts of your business are going to be more important to you than others in terms of staying on top of. Like, say you're paying rent and you're paying rent every month. It's the same amount every month. Okay, you get that. You've dealt with it. Move on. You're not going to need to keep on top of that. If, however, your rent includes portion of your sales, you're going to need to think about that. So here's some terminology, your operating expenses versus your capital expenditures. I think we talked about this, right? That operating expenses, they're the things that go through your income statement. Capital expenditures, you've laid out money, but it's still sitting on your balance sheet. Okay? Supporting documentation. So what is supporting documentation? CRA needs supporting documentation. It's your invoices, your receipts. You need it for CRA. You also need it if you have a dispute with any of your customers. You need to have that. Or your supplier. If you don't have a copy of the invoice, how are you going to argue that they overcharged you? You need to keep that. You need to keep it in a way that you can grab it when when something happens. You need to keep it and keep it in a way you can find it. It's also support for your bookkeeping entries. If your business grows to the point where you're needing to issue financial statements that other people are using, like your bank or your investors or something, and they want a review of your financial statements, they're going to ask an independent person to come in, look at your financial statements and say, is that picture that they gave us of what the company's situation is that a fair picture of the company? That person, it's an accountant, will come in, an auditor, and look at it, accountant or an auditor, and look at everything. And for everything you've put in, he's going to expect you to have a supporting documentation. One note, credit card slips are not enough. So in general, if I go to the grocery store, they are, because at the bottom, like it'll list absolutely everything that I bought. It'll list the day, it'll list where I was, it'll list all that kind of stuff, the address of the company name, the address. It'll list absolutely everything I bought. At the total, there will be a bottom. It'll show the taxes and it'll show that I've paid. Now that's a good, the credit card slip you get for that from a grocery store is fine. But very often, when I go to my hair salon, I pay and they give me my credit card slip and it's got like the amount that I paid, maybe some spot for a tip and then the total. It doesn't say what I had done. It doesn't show I had this at this price and this at this price and this at this price. Here's the total, here's the tax. And if it doesn't have that, it won't meet CRA requirements for documentation. So they could say, well, you're not going to be, well, I wouldn't be expensing my haircuts, but if it were on something that was a legitimate business expense, CRA could say that's not sufficient documentation. And you have to go back to them and hope that they, could retrieve a transaction invoice, which good luck. So just be aware when I tell you get the receipts and whatnot, make sure it's not just the credit card receipt unless the credit card receipt itemizes everything. Very often you've got something stapled to something. It's the more detailed one that you need. So keeping the books, shoebox, great. Just throw everything in there and have somebody else put it on if you really can't do the math. A spreadsheet. Is there anyone that doesn't know how to use Excel? Okay, I'm not seeing anybody, so good. That's really good because Excel, on the financial stuff, Excel can be your best friend. And an accounting software, if you feel good, you can do your own bookkeeping. QuickBooks is a great tool. Now, a lot of banks allow you to download your transactions from the bank and put it into a software like QuickBooks. Does anybody do that? Does anybody take their transactions and download them in and then use that to record all your stuff? I recommend that for your business stuff, I do it for my personal, but again, I'm totally retentive. For your business stuff, don't do that. And the reason that I recommend not doing that is because you should be recording your transactions from your own source documents. So if you are making sales, you should be recording all your deposits and your sales from your own understanding of your sales information, not from your bank's understanding of it. I know that I made, because of my sales system, I know that I made 20 sales at X dollars, and the bottom line total is this, and that's the amount that gets deposited in the bank. And so you know that that's what's recorded. When you come to do your bank reconciliation, the bank reconciliation is the comparison of what is in your books to what the bank statement says. And if those two things are different, then you follow up because something's problematic. Either they missed an entry, or you didn't deposit what you thought, or a check didn't go through. Like, all kinds of things can happen to make those things different. Now, banking is better than it used to be. So it's not that often that your bank just plain makes a mistake. But what can happen is if you think based on your sales information, the summaries on your website, or that, whatever way you have of tracking stuff, you show that you made those sales and that's what went over to your bank, and your bank doesn't show that in the deposit. How are you going to know that if you rely on what the bank tells you? You download that and that's what you put into your accounting system. You're not going to know that there's a difference between that and what you expected to see. And that's where you can lose revenues. Particularly if you've got a business where there's cash involved and you've got people helping you and employees, and you say, take this to the bank. Well, you want to make sure that all of it arrives at the bank. You know how much was supposed to go to the bank. If you're relying on what the bank tells you to enter that, then you're not going to know that actually it was supposed to be, $20, $100, $1,000 higher. The same thing with checks. If you're relying on that for the checks, you're just uploading and putting in the right whatever. You're not actually looking at what they're doing. And it's much harder to tell if somebody's, added a zero to the check that you wrote them, or the transfer has gone funny in a different way, or, I'm using examples that are probably a little bit archaic in terms of the way people do banking now, but there are many ways, many reasons that what the bank has could be different from yours that isn't about bank error. And so this is a really important control, to be knowing for yourself what your activity is and not relying on the bank to tell you. Does that make sense to everybody in terms of the concern that I'm trying to express to you? And that's why I harp on doing your bank reconciliations on a timely basis. My niche when I was doing consulting and as a CPA was doing startups. So when the government wanted to do something that wasn't part of government proper and they wanted to set up an agency or a crown corporation or something to do that, we'd go in and we'd build the infrastructure, and then we'd be the executive team until they hired the CEO and the CFO and whatnot. And so we'd set up the banking arrangements and the systems and whatnot. And many of the banks would say, unless you're doing a daily bank reconciliation, we can't be liable for things that are falling between the cracks. So that's how important this kind of stuff is, that you have to be really on top of your bank stuff. Now, for what you guys are doing, I think monthly bank reconciliations are going to be good, and you're probably going to be dealing with your own activities around banking. You're going to be doing them yourselves probably quite a bit, but still you can make mistakes, and I think that's good ways of tracking onto it. My family used to say, I can't remember who it was in my family, but somebody in my family used to say, you can't actually know for sure. You think you know a person really well, you can't actually know for sure how they're going to respond when they're tempted by either sex or money. So hopefully in your business, you don't have to worry about the sex part, but the money part you always have to worry about. Okay, so again, talking about documentation and is something verifiable, and what is a record, like your books of account and having financial records. What is a record? You've got your customer invoices, supplier invoices, purchase orders, contracts, bank statements, reconciliations, financial reports, expense claims, mileage logs, tax returns. All of those are records. The books of account are records. That's sort of terminology. So do I need an accountant? I would say you want to probably find someone who can help you, whether you need them to help you with everything or with just a few things. I think you should find, when talking to people or whatever, find somebody that you can go to when you need them. The considerations about how much you need one will be, can you do your own tax filings? If you're borrowing money in any great amount, a lender will say, I want, quarterly or annual financial statements, and I need them to be reviewed. And that means reviewed by either an accountant or an auditor who will do accountant's comments or a review or even a compilation engagement. And they will want to then root through your supporting documentation to satisfy themselves on the the verifiability that you didn't just sort of make up the numbers. There also might be issues arise that you feel out of your depth. Like, think back to when I was talking about your decision about, are you going to lease a computer or are you going to buy one? And I talked about if you lease one, the way that you would account for it is you would throw it on your balance sheet as an asset and you would amortize. How do you actually do that? There's some calculations in there. There's some technical stuff in there. You want to be able to maybe get somebody to set that up for you so that you can then just do the entries. You don't want to have to necessarily learn how to do that. You might want to ask an accountant about that. Ways to minimize costs. Accountants will, they base their fees on time. So even if they're giving you a sort of an estimate for a job, it'll be driven by how many hours they think that job will take. So you might want to think about the difference between an accountant and a bookkeeper. So when a bookkeeper really enters transactions, so you can give your shoebox of stuff to a bookkeeper, have them enter all the transactions, and then give you reports and all that kind of stuff. And then if you're required to have your financial statements reviewed, get an accountant to review that, because bookkeepers cost less than accountants. You could use something like QuickBooks and do it yourself. QuickBooks is quite easy to manage for even non-financial people because it sets it up like you're doing something. So when you make a payment, it's like writing a check. So you put the person's name in it, you put the amount in it, you put what account it goes to, and QuickBooks figures out what's the debit part, what's the credit part. It knows to take it from the bank and charge an expense or an asset. Like it figures that stuff out for you. It generates some really nice reports that you can review. it's manageable. You'll probably need someone to help you get it set up if you're not financial, but what I think is buying versus getting a monthly subscription. The monthly subscriptions can get pretty pricey. I would say the biggest thing on that, excuse me, is your payroll table. So if you're not hiring anybody, and if you're not paying payroll, you know, to a lot of people, I would say buy a QuickBooks. I go to Best Buy and buy QuickBooks there. And then you're not paying forever. And if it gets out of date, like who cares? The way you record a transaction doesn't really change. The payroll tables change, but you know, debits and credits don't change, and your chart of accounts might change, but any version of QuickBooks will let you do that. So you don't necessarily need to buy the latest one every year. You can have one for several years and then update, you know, if things are getting more complex or something. So I would say in the long run, I find it cheaper to buy it. You want to organize your information. As I said, people charge by the hour, and their estimate of how much they're going to charge you to do your bookkeeping or your accounting is largely based on what kind of shape your information comes to them in, because that determines how much work they're going to have to do. You want to separate out your business and personal, and you want to follow advice. If your bookkeeper or your accountant tells you how to do something or tells you that it's important to do something, do that and you'll save yourself a lot of headaches and money. Why I like QuickBooks. It is sort of the most widely used programs for small businesses. I think something like 90-something% of small businesses use it. It's got like that kind of market share. It's easy to find and install, but they do push the subscription, the monthly subscription online. If you go to the Intuit is the company that makes or sells QuickBooks. If you go to their site, I'm not sure you can find out how to buy it outright, but you can, as I say, go to Best Buy and buy it. It's easy to get help on QuickBooks because lots of people know it. It's going to be around forever, and it's not actually temperamental. It doesn't sort of programs doing wonky stuff. It doesn't do that. It's relatively intuitive to use, like checks and all that kind of stuff, lots of drop-down choices. And it figures out the accounting mechanics behind things. It's hard to lose data. It reminds you to back up. You can back up, you know, in the cloud, and it's very easy to restore. If you've gone off the rails, you can go back and restore it at a certain date and sort of redo yesterday. It's got a very solid set of canned reports. So the reports that come with QuickBooks, it'll produce your income statement, it'll produce a cash flow, it'll produce your balance sheet. You may want to have a more detailed cash flow when you're creating your, like it uses the income statement as a starting point for your cash flow. So you might want to have a cash flow that sort of itemizes everything, but they're good. Have great reports about your receivables and your payables and your, you know, inventory stuff. It's easy to fix things like if you're entering something and you make a spelling mistake, you can go back and fix it. And you can create an invoice in QuickBooks and then within QuickBooks email it to customers and that kind of stuff. So it's got some nice features. You can create your own invoice layout and put your logo on it. There's, you know, stuff like that you can do. The other thing that's really nice is that if you buy it or have a subscription to it, you can create as many companies as you want. So you can create, you know, if you've got 3 like little side hustles going, you can have a little set of books for each side hustle. You can do your own personal books. I've got, you know, me and my husband on what I fired my husband as a bookkeeper. He's also a CPA. he had this slush fund that I just couldn't go with. But we do keep our personal stuff on, you know, and it just makes it really nice to plan finances. But again, I'm retentive and a dinosaur. But you can keep your stuff separate and still have your business on it too. And it can grow with your business. So I mentioned what I used to do in a prior life, setting up, you know, government agencies and stuff. And during that first sort of few years of an entity, it keeps changing. It keeps changing organizationally and structurally because you think you know, and you're experiencing this, I'm sure. You think you know how you want to set things up, and then you realize you get a little more information and go, oh, well, this would work better, and you change things. If you buy a big, heavy system, very often it requires you to lock down your chart of accounts at the beginning of the year, and that's the structure you got to go with until the next year, and then you got to think about it, and then you're limping along kind of out of shape because things have kind of morphed. Whereas QuickBooks, you can drag and drop and reshape according to how your organization has structured or how you want to think about things, and it'll pull the historical information and you can morph. So even in those big organizations, you know, the Ontario Energy Board, the Ontario Power Authority, big organizations with millions and millions of dollars, for the first 18 months, we were using QuickBooks. It's also got a lot of robustness, so you can track projects and various things. And, you know, when you know that you're going to change, but you don't know what that change is going to be, it's a really good tool to have something like this that will, you know, move with you until you get some stability in what you need to have your hands on. And at that point, then change to perhaps a more robust. If you are going to do QuickBooks or any kind of accounting software, focus at the beginning. You set up your chart of accounts, get that solid, understand why you're doing it, and then you'll understand why, if you do need to change it, how you would like to change it. That will become logical. This can be worth getting some help in this area. And QuickBooks has some sample ones. Other softwares would as well. It's easy to make changes and improvements. Oh, sorry. I told you that it came with some really nice reports. You can also take some of the reports or create brand new ones from scratch very, very easily. And it's very good in its report. And you can memorize those reports so that you can just spit them out every month. And then you can also set up memorized transactions. Like, you know how I said, if you're leasing and the transactions, how you record it is a little bit complicated. You can just set up a memorized transaction and just, you know, put the months in, you know, change the amounts each month, and it sets up the transaction for you. It can do it automatically if it's just a matter of rent. You pay the same rent, you can get it just to do that, so you don't have to do that transaction. Or you can get it to remind you, oh, it's the first of the month, do such and such a transaction. And learn how to reconcile the bank and credit cards in case you haven't picked up that I would like you to do that. Okay, how are we doing? Still with me? Okay. So that's the transact and report. So as you do transactions, record them. Get something. Even if you don't want to use QuickBooks and you want to set up an Excel spreadsheet and you know how to do that, or you can get some help, do it. That's really, really important. In terms of report and monitor, I was talking about some report. Oh, and I should just say, I have absolutely no connection with QuickBooks. They don't pay me for anything. They irritate me quite often in terms of the, you know, company and the buying and the subscriptions. I just use it a lot and find it a really functional tool. So it's no interest in QuickBooks. Reporting and monitoring, I find the least painful approach is to schedule a routine. This is really important to do, and it will be the least amount of work if you just slot it in that every month, so many days after your month end, you close off the month and you issue a set of reports and you look at them and you review them. And if you just like put it into your calendar, X number of days after the end of the month, this is the day that I do all of that. That saves you from the decision of when am I going to do this, when am I going to find time to do it. You just book it into your calendar. Today's the day I'm going to do whatever. And then you will figure out, as you start to work with stuff, you'll figure out how often you need to look at each thing. And then you're going to schedule reports accordingly. Some things you'll need to look at every month. Some things you'll need to look at, like depreciation or amortization, it's once a year. Unless there's some reason that it's otherwise. And some things you'll want to do daily, weekly, monthly, quarterly, annually. Like the daily and the weekly could be looking at your receivables If you've got, if you have things that are sensitive and you've got things that are, you might be wanting to track, depending on how people who are helping you, how much responsibility you're giving them, how, it helps you be able to regulate how closely you watch somebody who's helping you. Is, I'm going to look at this every day until I'm comfortable that they know what they're doing. Then I'm going to look at it every week. It can satisfy me on a weekly basis. I'll look at it every month. Like it can change. But it's important that you do actually spit out the reports or develop the reports. And it's not just on financial numbers in terms of costs, it's also on activities. So you want to think about this for volume of sales or any kind of number that's important. So I say you want to print out your reports and you want to review them. And I say that with tremendous confidence. And I know that some of you are probably going, review them for what? What am I looking for? How do I look at a financial statement, I haven't a clue whether that's good or bad or indifferent. So that's what we're going to look at right now, is what the best thing I can do for you is give you the questions that you need to be asking yourself. Okay, so if you have a good list of questions, you will be really good at this. So and it will come over time. If you keep asking yourselves these questions every month, you're going to hone in more automatically. You're going to look at your list of questions less often because you're just going to go straight to the things. And what I want to say before we really go into this, because we're going to get into this a bit, is figure out what you need to know for your business. You have to figure out, and this will come over time, look at everything for a little while, and then you'll start to realize that's not bothering me this month. Like, again, amortization. I can look at it, but I don't care about it till I'm doing my books at the end of the year. So what will be important for you is different than what will be important for another business because of the mix. Do you have inventory? Do you have, cost of goods sold? Do you just have services? Do you, is time important to you, or a variety of reasons? So over time, you will learn what you're looking for. So you'll look at something and what stands out, what is good, what is bad, what is unexpected, what's new, what's missing. Oh, here's something that I haven't seen on these statements before. And that will happen more if somebody else is doing your bookkeeping for you, right? If you're doing it all yourself, you've entered it, so you know what's coming up. But then when you do your review, you have a chance to look at it and say, oh, yes, that's right. I did that this month and I haven't had that before. Look at what's missing. It could be that you forgot to, record all your loan payments, or there's a whole bank like a whole bank account that you forgot to record the activity from that bank into your books. Like, look at it. Does it make sense? Is there something that stands out to me that I'm used to seeing? And again, that comes with time. Benchmarking is a really good way to evaluate. So you want to compare, again, we were talking about relevant company or industry information, those performance indicators and the measures that you're trying to hit. You want to compare how you're doing against how the rest of the industry is doing. A little bit hard if you don't have insights into the industry, you don't have firsthand information. We talked about that. But you want to, where you can, you want to compare it to what you know is happening. You also want to compare it to your own prior reports and statements. That is like really great information. Here's this month, here's last month. They're exactly the same. Should they be the same? Didn't you do more work this month than you did last month? How, think about, does that make sense in your circumstances? Compare it to, think about the level of activity, think about how your business went. Is that showing up in what you're seeing there? And again, compare it to the performance targets that you've set. So we talked about your business plan showing like over 3 years, if you're starting out and then, stabilizing and then growing. And in order to do that, you're hitting performance targets of, by the first quarter, I want to be selling this many, by the second quarter, this many. And, well, first month into your second quarter, are you still where you were at the end of your first quarter? Are you going to be hitting your performance target for that quarter? And ratio analysis is another way of reviewing your reports, because what it does is it takes different pieces of information, like you've got your statements, and they compile the information very nicely and they summarize it for you, and then you can compare it against previous periods. But what ratios do is they take pieces of information and they put it together and compare this to that and say, is that what you're looking for? So ratio analysis is really, really useful. We're going to do a whole piece on what ratios tell you what and which ones you should use. As we go through that discussion, think about, does this help me in my business? Pay attention or circle the ones that help you. And you know, if it's inventory turnover and you don't have inventory, then you know, save your brain space for something you do have. But the most important thing is that you know your business well enough to determine what information tells you the most important things about your business. For your business, what is important to know? What is important to keep on top of? So make sure you know what you need to keep on top of and keep on top of it. Do it at least monthly. So here we go with the ratios. So this is the one that even finance students find like nauseating when they're learning it. But the way I've tried to present it is, what is the question that I'm trying to answer? And then you look at what the formula is, and if it makes sense to you, don't worry about like memorizing all these ratios. Worry about remembering the questions that are important to you and having the ratio handy so you can figure it out. Don't tackle it from I've got all these ratios to memorize. Tackle it from, I've got these questions and which are the right questions for me, and I can figure it out each time if I need to. Okay, so even Dave's having trouble with this one. I saw the yawn. But to give him credit, he went through this whole thing yesterday with me, so he has a right to be a little bored. So the first question is, are my sales enough to cover production costs, both the fixed and the variable? So sales, production costs, that's sales minus production costs gives you your gross margin, your gross profit. So your sales in a dollar sense, how much are they? Am I making any, you know, am I covering my direct costs? And you really need to be, that is your sales minus your cost of goods sold. As a percentage, you take that difference and divide it by your sales. That tells, if that number is negative, stop, because everything you sell is losing you money. You really need to think that. Every sale you make, you're going further into the hole. You really need to tweak things before you keep going. So you want that to be a positive number, and you want that number to be an attractive positive number. Because everything that you make after you pay for all the like raw material kinds of things goes into covering all the other kinds of costs. So then, are we charging enough for this particular product? This is your contribution margin. This is basically your gross margin, your gross profit per product. So if you know what price your product is and you know the cost of all the direct things, your for me and my fashion design stuff, you know, the cost of my zipper, the cost of my fabric, the cost of my thread, the cost of my pattern making, you know, all that kind of stuff to design the pattern for this particular garment line. If I know what the cost of that is, I know how many, you know, I break it down into a cost per unit, then I know what my price is. I can tell you what my contribution margin, each unit of that garment that I sell is going to go, you know, pay so much towards my other costs. And there might be some that are relatively higher than others. So you might have some products that you sell 1,000,000 of them, but you only make like a really small amount on each one, that's okay. And you might have other ones that you make like 100 of them, but you make a much bigger contribution margin of them. So you want to think about those and want to know sort of the relative value of each contribution margin, each product by their contribution margin. Is that concept clear to people? Because that's an important one. Anybody who sells or resells stuff needs to understand that. How much profit does each dollar of sales earn? Excuse me. I think about this as more of a curiosity one. My net income divided by my net sales. So if I sell $1, I make this much profit. That's sort of what it's telling me. That's the bottom line sale. There's another one that they call operating margin, which is sort of the same thing before you take into account amortization and interest. Again, you find the one that means the most to you. This is sort of a curiosity one. I don't think this drives the business. The contribution margin one is much more important, but it's kind of fun to know that. When am I actually making money? So what's my break-even point? When do I, what dollar amount do I need to sell? And in talking about net revenues, in order to cover both my fixed and my variable costs. That's your break-even point. And how many, what's the volume that I need to sell to break even? Same concept, but it's volume as opposed to dollars, okay? So your fixed costs divided by your sales price minus the variable costs. So essentially you divide your fixed costs by your gross profit. And you see at what point have you sold enough. And of course, if you have the different products with different contribution margins, you kind of have to figure out, you have to estimate how many you're going to sell of this one and how many you're going to sell of that one to figure out, because there's going to be different mixes that will bring you to break even. You understand what I'm saying with that? Okay. How much is, so there's still, we're talking about all of these ratios that we've been talking right now about are with respect to profitability. That they speak to how profitable you are. So this, if we want to say how much is the business earning on its investment? Well, the business is earning, like all the assets that the business have are put into earning money. And you want to make sure that you're earning more, that the business is earning more by doing whatever it's doing that it could do than if it, just puts in the money in the bank and earns interest. Otherwise, like, why are you putting all this blood, sweat, and tears into it? That's called the return on assets. So you take your after-tax earnings and you divide it by the total assets. Again, as you look up different ratios, different, textbooks might say you want, before tax earnings or after tax earnings. Again, my thought back to you is the definitions might change a bit. So figure out which is the one that you care more about. Do you want to know what it is before or after tax? What's more important to you? The question about how much am I earning on my investment in the business? It's not all the assets, it's the amount of assets that I know. So it's my investments, the after-tax earning over my investment in the business will give me my return on the business. Now, if I've lent the money business and I've put money into owner's equity, you want to come up with after-tax earning divided by my investment and my debt, right? So you can tweak these things. As I say, this is sort of what they are in textbooks, but you have to think about what do they mean to you. Now we want to switch from pure profitability into efficiency. And this is where I say you get your baseball bat out and you whack over the inventory over the head until it behaves. So how long does my inventory need to be financed? So as long as your money is tied up in, my 200 bolts of fabric that are sitting there untouched, I don't have the money from that to spend on other things. So essentially, I'm financing that inventory until I sell it, right? It's me that's having to pay for that. Like if I could sell that, I would have money and I could do other things with that money. So how long is my inventory sitting there? So you take your total inventory purchases and you say, how much inventory do I have on hand now? So year end, when you take your inventory count and you count your inventory and you figure out how much it's worth, and then you count how much I purchased over the year. Well, if I purchased over the year $1 million and I have $1,000 worth of inventory, I have turned over my inventory a whole lot of times. That inventory is just spinning through my company, right? Because I bought $1 million worth of stuff, but I only have $1,000 worth on hand at any time. I must have been really selling like hotcakes. That's great. If, on the other hand, I bought $1 million worth of inventory and I'm kind of sitting here with 900,000 of it, I'm like really overbuying, because unless it's a weird point in time, like if that's on average what I'm doing, and again, this is why you do it monthly, is you can tell, like, is your inventory going up and down? And maybe you had to take advantage of a bulk purchase. Okay, that's good. But if on average your inventory is really high compared to how many sales you make and get out of there, you're carrying a lot for a really long time. And that's expensive because you're paying for the goods way before you sell it. So your cash flow is out and then not in again until way down the road. You're also having to pay for somewhere to store it. You're having to like make sure it's not stolen. You're having to protect it. You're having to, plow through it to find the thing you want. Like it's this wonderful thing. And I don't know if you noticed on the picture I had before of your inventory and managing it, I had a little shadow picture where there was this really cute little cat. Everybody loves their inventory because it's so exciting, because it's what your business does. And you've just bought some new sparkly things and you're going to do stuff with it and then sell it and it's going to be wonderful. But the shadow on it's like this demon thing that it's kind of, I fooled you. I'm actually something that's going to get out of control really quick. And that isn't that like a cat. So anyway, so I just want you to think about the inventory a lot. So this, when it talks about how long have you had something, how quickly are you turning things over, how smoothly is that working, that's to do with efficiency. Okay. And so another question is, how long is it before customers are paying me? So it's your average collection period. So if in general you sell $1 million throughout the year, and at any given time you have $1,000 of accounts receivable, people that haven't paid you, they total $1,000. Well, that's actually not bad. The most you're going to lose on $1 million of sales is $1,000. That's actually, doing good. Now, if all of your sales are, you don't hand it over until you get something, you might have some issue there. But it's very different than if you make $60,000 a year and you've got accounts receivable for 30. Tells you something very different, right? And if you have an accounts receivable for 30,000 for 6 months, month after month after month, when you're looking at it, that's a problem. So this is the picture of how you can use that information and why it's important to stay on top of it. And then, of course, you would go to your accounts receivable listing and look at who are your biggest customers that owe you money and how long have they owed you money for. And you need to be pushing back the numbers. If somebody's owed you for 90 days, you need to keep pushing it back. So the only people that owe you money have only owed it to you for less than 30 days, right? That kind of a thing. Another one with, sorry, hang on here. So now we get into liquidity. So this is about your cash, your ability to pay. How liquid are you? So am I liquid? And there's something called a current ratio, which is also known as your working capital ratio. You guys probably have talked about this. It's your current assets minus your current liabilities. So current assets are things that you sort of have on hand that you can turn into cash. So it's your bank accounts, it's your, you know, if you have some investments, T-bills or whatever, GICs, it's your inventory, it's your accounts receivable, it's, you know, your deposits on hand. You've got money there. And your current liabilities are the things that you're going to have to pay pretty much in the next year. So what those two things, if that percentage, like if your current assets divided by your current liabilities is more than one, your answer is yes, I'm liquid. Whether that's good enough depends really on your industry. So, you know, if you've got a cash business, you might need to be, you know, taking advantage of sales or things coming up. You might need to be able to buy things quickly, might need to respond quickly. Other things, you know, you can pay for over time, and you know, everything is with a contract and it's all laid out, and you've got things thought through. It depends on what your business is, how liquid you need to be at any given period. The can I pay my bills is the kicker one, because if you take out your inventory, because there are companies that will, it's called factoring your inventory. If I've got, say, my 200 bolts of fabric that I have because I love to see it and I dream about what I will make with it when I get some spare time, but I'm too busy doing my business to ever have that time, I can actually hand that over to another company. They will buy it for me and give it to me, and then they will go ahead and sell it. And so I can, at a discount, sell my inventory, not for what I would have sold it for if I turn it into something and sell it or resell it properly. Like if I buy it for resale and I sell it through my regular channels, if I just get them to take it for me, they'll do that, but at a huge discount. The quick ratio takes out the inventory. So forget about inventory. If you needed to get the money faster than it would take you to sell it a different way, this is really, can you pay your bills? Is your ready cash enough to pay your bills? And if that's not in good shape, you can really run into trouble quickly, right? That's where you need to do your bootstrapping and think, talk to your family and think about your credit cards and stuff like that, but it's not a good place to be. Okay? And that's why you want to look at that often. You want to make sure you're not getting yourself into trouble there. And that's another way that your inventory can sneak up on you. Okay, leverage. And was it yesterday you had the investment people, or is that tomorrow you're having?
Tomorrow.
Tomorrow, okay. So they're going to be probably talking lots more about this, but essentially leverage is how you're using one thing to supplement or change the balance of how much you need of another thing. So debt and equity are things, how much debt do I have to how much equity I have? So how much do I owe people for the assets? Like how much in sense do other people own in my company versus what do I own myself? Because your assets, do everybody remember assets equals liabilities plus equity? So the amount you owe other people is their share of your assets, and your equity is your share of your assets, right? So how does their risk compare to mine? If you have huge debt and a really small equity, wow, you were good at getting your financing. But it means that you're really leveraged. You've got a little tiny bit of equity in there and you got lots of debt, and wow, you can have a much bigger company asset-wise than if you only had your own investment. But really, I put this, a bank perspective is you go first. They want you to ante up before they pitch in. And a lot of people joke that the bank will only lend you money if you don't actually need it. But it is. The lower number on this debt to equity ratio indicates a relatively bigger investment by you, and therefore a better ability to repay the debts, because less of the money has to be found to go to them than to you, and they will get paid first. And then how much of my assets are financed by others? It's you take the total company assets and you divide it by the debt, and that's that tells how much the percentage of business that other people are financing, because you're borrowing money for it. And again, the bank's perspective is less is more on that one. And a lower number indicates a better ability to repay the debts or increase your debt for new opportunities. If you get it nice and low, then you can make it a bit bigger and it's still not out of whack. Okay, so we've got down to report and monitor. So you've got you've done your plan. You've started your activities and you're recording them all along the way, and you're spewing out your reports every month and you're reviewing them and you're asking yourself all these questions, and you've got all these answers and you've got all these benchmarks and you can see how you're doing compared. Okay, so now you have to evaluate, and you evaluate on two directions. You evaluate back to looking at your transactions. So when you start to evaluate and you say, I've got all these reports, I've done this analysis, do I like what I'm seeing? If you don't like what you're seeing, don't wait to the beginning of the next fiscal year to fix the activities. You can see right away that something's starting to drift. You can change what's actually happening in your company. You can see that if you're, all of your customers are, they're not buying very much and they're taking forever to pay, you can say, I need to start, spending less time with those customers and more time with the customers who are really quality customers. I can change behaviors about what I'm actually doing. These products are going, but these products are, slipping. I need to push these products more, what's happening there. So back on the transaction record, as soon as you were evaluating and you're starting to think about these things, don't hesitate. Fine tune, tweak, make changes as you need to what you're actually doing, because your plan hasn't actually changed. You're finding that your results aren't hitting your plan. And as you're evaluating, you're not liking what the results are coming in against your plan. You need to shift that. Or if you're seeing, that things the circumstances are shifting, you can tweak them, but you can have an immediate and direct impact on what you're actually doing. And that's how you stay profitable, is that you don't sort of go, oh yeah, I got the reports, and you file them away. You actually look at them, you evaluate them, and then you think about, okay, so what have I got to need? And we'll talk about the questions there. The other way you want to evaluate is, as you think about what you're not liking, you're thinking, I'm seeing trends here. And what it's showing me is this product is making a much bigger contribution than that one. Next year, I'm gonna plan to focus on this one more than that one. My plan is actually going to change. I'm going to, I see that this is, disappearing and that's becoming more of a trend. I'm going to put that, and you put that into your planning notes. You don't necessarily change your plan right then, but you can actually change your activities and what you're doing. And what you do is you track all that stuff and keep track of that stuff. And then when you come to make your next plan, you incorporate all of that into your plan, and your plan is just so much better the next year, because you've thought about all of this stuff throughout the year. You've realized what works, what doesn't work, what you thought is different from actual, and all that kind of stuff. And then you build a better plan for the next cycle. So you want to analyze your reports. You want to follow up on unexpected results. And now you're starting to see, what do I mean by unexpected results? From those ratios, you set them against the benchmarks. I set that target. I'm not seeing that target being achieved. That's an unexpected result from your plan. Or something happened in the month. It is, I thought it would drastically affect the business, and it's not. So what's up with that? So you've got some follow-up questions there. And you think about, okay, this is what's happening here. Did that account for the circumstances that changed this month? Or I've got a change coming. How is that change going to be affected by what I'm seeing here? Or how is that change going to affect what I'm seeing here? So has it impacted or not impacted in expected ways? And do I need to now change my focus and adjust what's more important? You know how I said, you got to figure out what's important and focus on that. If you've gotten to a certain point where you've achieved that benchmark And now this other goal kicks in, like maybe you said, I want to do this by the end of the first quarter and that by the end of the second quarter. And you achieve that by the end of the first quarter. Okay, good. My focus shifted. Now I'm moving on and I'm going to be focusing on something else. So that's how you think about, does my focus need to change? Okay, good. I hit that. That's a good, I've incorporated that as a solid foundation into what I'm doing next. But what I'm doing next, I need to focus on this instead of that. And okay, so how do you go about evaluating? Analyze your benchmarking calculations. Do the similarities or differences against the benchmark make sense in the circumstance? Should they be greater? Should they be smaller? Do they reflect the results of differing strategies? So did you change your strategy deliberately? I'm going to try this and then I'm going to try that. Or I'm going to do two things at the same time and compare. Do the numbers show that that was worthwhile? Which one is better? Where are things headed? And are the benchmarks still relevant? So, you know, if your competition took off like fire, is last year's performance what you should be still pegging against? Or are you going to lose your market share if you don't, if you do? And think about your business goals and objectives and ask yourselves questions about, do the results show whether or not you're on track? So sort of come back to overall, where did I want to be and what am I thinking of? Is this going in that direction? Or is this showing me I need to rethink things a bit? Is my pricing strategy working? Are we attracting quality customers? What I said about strong sales and timely payments. Do we need to think about a different market group? Have I got my market right? Are we carrying enough or too much inventory? And that's something you can fix. Like you can pare back your purchases or you can factor it out or something. What were my assumptions about what's driving my costs on target? I thought that this would be driving my costs. It turns out my costs are really higher about something I never even thought about. Took me by surprise. Why are the labor costs high? Like, is it that the units actually take longer to produce than I thought they would? Or are we producing them right on schedule, but half of them need to be redone? Are we having defects? Are we, is something happening there? Is there something weird? Are my marketing investments paying off? You might be investing in a new marketing strategy. Maybe it's too early for them to be paying off, but like, are we seeing something? Can we afford our overhead? Do we need to think about doing it in the garage? And are the results tenable? I had a fantastic month. This is really great, but I know it's not going to last because of this and this and this that are temporary circumstances that I'm not going to get again. Okay. Does that help you picture how you evaluate? Give you any ideas for the kinds of questions you need to ask yourself? The best tool is a good set of questions. And that's something to like go at your mentors about. What do you ask yourself? When you look at a financial statement, can I watch you review it 1 month? Can I see you go from here and then you go down here and then you go over here? Like what is your thought flow? Like even say, can I shadow you a bit? And see how they do it, get them to talk out loud. Like, I mean, if you've got this really wonderful mentor who's going to do that, get them to review out loud what their thought process is. That's that's the best thing, and you'll pick up on questions that you didn't think to ask. Okay, so now we're coming back full circle to planning again. So we had dealt with the research, the compile, and when we talked about adjust, you can also understand how all of those things will help you adjust your plan as well. Okay, so now, yes, that assess and adjust goes back into the plan when you finished your annual cycle. And also for your first time, when you're setting up, you're setting up your budget and your plan for the first time, you research, you compile, then you look at everything and you say, does that make sense? All these questions that we've just asked will help you assess and adjust your first plan too. Okay. So in adjusting, you want to take corrective action to fix your activities that are causing suboptimal results. I haven't lost anybody with suboptimal, right? Incorporate your analysis into the next round of planning, but only change your plans, including your budgets midstream if you've got a huge thing. Now, COVID was something that caused people to go, time out. I have to redo my business plan. I have to redo my budgets. This is like overwhelming change. Like COVID is something that caused people to actually change their plans midstream. January 1st, you started if your fiscal year was the same as your calendar year, you start the year January 1st. By March, you were going, I need a new plan. Nothing in here is shaping up the way I thought it would. Okay, that's an example of when you would change your plan. But if your actuals are not the same as your plan, you don't create a new plan. The idea is not to get those to zero. The idea is to improve your planning so that next year you don't have as big of a difference and you get better at the planning. But if you keep changing it, you're not actually learning how to plan better. You're just resetting the numbers without really understanding how to plan. So you do though want to use your evaluations to update your goals and your strategies and your targets and your processes. You want to keep thinking about those kinds of things and the whole continuous improvement thing. But you rarely want to go back midstream and change your actual plan. So, there is hope. It's this business plan that you're doing that seems to be taking forever and the gut wrenching and you can't wait to be done. I don't want you to revisit it every month. I do want you to wait till the next year to do it.
Kelly, I have a question for you.
Yeah.
So like in a situation such as COVID, where like absolutely basically everything is unknown for a lot of business owners, would you kind of recommend maybe you reevaluate your plan maybe a little bit more often as things are changing versus like, year over year, things kind of steadily
Yeah, I mean,
are increasing?
COVID is truly extraordinary.
For sure.
There's never been quite as significant a disruption in my, 30-year working career. But you do have situations where the economy takes a hit. 2011, 2013, 14, it was a bit, 2007, 8, like it from time to time when 9/11 happened, all of a sudden things go in like a day and your financing is different and people don't have the money to spend that they did and things like that happen. So I think that COVID is truly extraordinary, but there are other big hits. So yes, I think that really everybody started back to where you guys were with your business and said, okay, it doesn't matter what we've done for the last 20 years and the fact that we know our business, we actually have to start a new plan. We have to start the planning process. We have to figure out what do we know, what don't we know, what can we count on, what can't we count on, and what can we do like immediately, and what do we have to wait to see what susses out. Very tenuous steps at the beginning because you don't know what direction things are going. After a while, people are starting to see they're getting more into, working. People are getting more comfortable working from home. People are getting more comfortable doing online sales. Okay, so we're going to pour money into that. Like, yes, it really was a start from scratch, and you have to be very nimble, and you have to be prepared to keep changing and keep changing and keep changing because you don't really know how solid the ground is under your foot. You take a step and you hope that holds you. You take another step and you hope that holds you. You take a sideways step back because we had a little flare up here. So you're not taking really big steps. So yes, that's a constant time of reevaluation and thinking it through. And yeah, you know what your big objectives are, but everything has turned to the focus of let's get through the night on this one. Okay, and we're getting through the night. Let's get through the week. Let's make sure everybody's priorities change, right? So things like economic downturns are more in the line of business risks that you should be incorporating into your business planning. In your environmental considerations, the economy's had some robust years, the cycle is going down. In your pessimistic, realistic, optimistic estimates, you need to factor some of that in. Those are the kinds of things that are business risks that you should be anticipating. No one could be anticipating a COVID. Or very few people. I mean, you know, and even if, I mean, there's business continuity planning, which is a whole field now. What happens if one day a bomb goes off and nobody can go into the office? Does your office know who to talk to? Have they got this set up? Have they got that, you know, all that kind of stuff? There was continuity planning, but nobody knew it would actually be applied to COVID. It was more thought of as there's a fire, if there's, you know, an airstrike, if there's something, if there's a power outage on the East Coast, or, you know, whatever. So you can quite often say, if something big happens and we can't, what would we do? But the X is always an X, right? And so this time the X was COVID, and it just like blew up completely. Does that answer your question?
Yes, it does. Thank you very much.
But that is the rare thing, like this, you're living in unprecedented times.
For sure, yeah.
So adjusting and incorporating your evaluations into your analysis. So now that we've done all this work and thought about it, let's go back to the revenues. Think about them. So let's focus on sales and pricing strategies to increase revenues. So sales and pricing strategies, is it, you know, the mix of what you're selling? Are you pricing it right? Are you going into the right markets? Are you thinking, you can see how from the numbers you've looked at and from the way you've looked at that, you can start to think about the answers to that question. If you haven't done any of that review and monitoring and analyzing and ratios, this is a bit of a guess. I think it's working. Now you have actual information to answer those questions yourself. Now when you review it and you look at that, you say, oh, okay, now I know, okay, I'm evaluating. This is how I use that information. I think about it in this way. Your pricing objectives, you want to maximize your profits, or you want to meet a specific return on investment. You want to hit a sales level. You want to gain or maintain the target share. You want to meet or keep out of competition. You want to ensure that all your potential revenues are realized, so you're not losing things because customers have taken something but not paid for it, or, you know, and now you take it back, but you can't sell it for the same because it's at a date. Your returns, things that aren't, you know, working right. You want to minimize all those things. So those are things that you want to incorporate into your revenue stream and thinking about, how do I make my revenues more profitable? And expenses, you want to focus on ensuring your expenditures, whether they're capital or whether they're whether they're on your balance sheet or whether they're on your income statement, you want to focus on ensuring that they're contained and that the resources are being used as efficiently as possible. So is it, you know, is my labor cost like, you know, God bless them, they're really lovely people and they work so hard for me, but they actually can't sew a straight line. I need to outsource that. So do I have the correct type of resources in place? And do I have the right, you know, quantity? I've got 3 people who are as busy as beaver and 1 guy that's, you know, on his phone all day. So have you got, is that really working for you? And then you want to consider if, you know, things are, you've got everything as efficient as you can. You squeaked every, you know, your pennies to, you know, you hit, well, I guess you don't pennies anymore, but you squeaked your dimes and, you know, help pinch your dimes until they squeak. You want to then think about bootstrapping. What can I do to reduce expenses? So you save costs by leveraging your non-monetary resources, your time, your reputation, your knowledge, your abilities, or your idle assets. Say when you did a rent, you got this fantastic deal and you got a lot of space for the price of a little space, but you actually don't need all of that. Well, sublet, you know, have somebody else come in there. And even if they can't, maybe it's a friend and you're helping them and they can't pay you, maybe they can help you do your planning, like something to help, right? I'm nice to you in this way, you can be nice to me in that way. Colleagues, you know, help somebody out. It's the fastest way to get help when you need it.
Kelly, I'm just letting you know we are down to our last 5 minutes.
Okay, great, because that is the end of the profitability lecture. What I'm doing right now is pulling from something I gave before and throwing in bits and pieces of stuff that there isn't really a spot to put it, but I wanted to share with you because I thought it might be helpful. So business structures, did you hear yesterday or is it tomorrow you hear about this stuff?
Yesterday.
Okay, yesterday, sole proprietor, partnership, corporation, other. I'm only going to talk about this in terms of financial stuff. Get it? How do you get money out of your corporation? Controls, and then I'm going to give you some samples. Okay, so sole proprietor, you're the business. You do need to keep, even though you're the business, you need to keep records separate from your personal, and you will have a December year end. Okay, your business activity is reported on your personal tax returns, and if you are paying yourself through a salary, you pay the employee and employer share of your CPP. You can get away without paying EI. You have to decide to do that, but you can decide to do that. Your legitimate business losses can shelter other types of personal income. So if you're doing this business on the side, it's making a loss and you're also making a salary, that reduces the tax you have to pay on your salary income. It's the simplest form of ownership, so you don't have to pay as much. But in some contexts, it can be taken less seriously. Partnership, you share everything. It's similar to the sole proprietor on a proportionate basis. So, you look at the business and if it's 60-40, then everything is 60-40 on the financials. You have to keep financial records for the partnership. So the partnership keeps it and then you split that 60-40 and you get to pick your year end. But your portion of the business is included on your personal returns on a calendar year basis. Again, it's the same. Legitimate losses can shelter other types of personal income. You need to get a formal partnership agreement, and the business is directly impacted by how closely aligned or not the partners are. If you start to drift, you can run into big difficulties. Corporation is its own entity. So anything that happens in the corporation, like it's got its own bank account, it's got its own relationship with CRA. It's like a person. And so it can sue or be sued, all that kind of stuff. So it can't shelter, like if the business makes a loss in a corporation, it can't help you with your personal tax situation. But on the positive side is if you make money, you can leave it in the corporation and pay tax later on it when you pull it out. And in that way, you can store earnings in the company. And you could decide how you want to take money out of the company. There is more documentation and is more onerous about government stuff. So how do I take my money out of the company? You can take salary, you get CPP and income tax withheld. Again, you can, if it's your own company, you don't have to necessarily do the EI. You can charge the company fees. And those fees that you charge would be a sole proprietorship business that you would report on your tax return. You would pay, again, on the fees that you charge on your own tax return, you would have to pay the employer and employee share of CPP and whatnot. If you're taking out dividends, they're very efficient from a tax perspective. The tax on dividends is nice and tidy, not huge. But remember that if you take it as dividends, you're not paying CPP. So your possibility for, if you're planning on having a Canada pension, if you're only taking money out of the company through dividends, you're not building towards having a pension. Okay? And loan repayments, if you loan the company money, you can take that money back. There's no tax consequence to that. And return of capital, if you've invested in the equity, you can take out like the equity that you put in, not the earnings that the company earned that you kept in the company. But if you put money into the company, here's 100,000, that's my equity in the company, you can take that equity out of the company. But if you sell your company, your value, your cost base, it goes down so that you have more of a gain when you sell it. Control is not just for freaks and retentive people like me. They're an effective way to manage risk. You've got different types. You can have a physical control, like you can have a gate around your property. You can have a policy that says, I'm controlling behavior. I'm going to have a policy that says you can't harass somebody else for various reasons. And you can have a process whereby you don't have the same person taking money to the bank that is recording how much went to the bank. You can have preventative controls is another way of looking at it, like preventing somebody from getting at it. You got a password or a lock in place. You can have a detective that if something happens, you know, there's a fire, the alarm goes off, right? And you can have a responsive that not only does the fire alarm go off, but you have a sprinkler system that kicks in. If something happens, then this happens. The level of control is always determined by how acceptable your level of risk is. So it's influenced by how often it might happen, and if it happens, how big. So COVID, like how often is it going to happen that your business is completely interrupted? But if it is, how big an impact does it have? COVID is a good example, low frequency, high impact. Same thing with a fire. But you know, the power going out might happen all the time, but it's not going to destroy your business necessarily. It's going to be an irritation. So think of those kinds of things. If it's a small chance of happening, but it's going to kill you if it does, deal with it. And one way of dealing with it could be buying insurance. So how do you mitigate your risk? How do you deal with it? Mitigate means how do you deal with your risk? And your business risks change, so you have to review them at least annually. Do it as part of your business planning. Samples, I'm going to hand over to Dave and Kelsey and Jen samples of a set of financial statements, a journal spreadsheet, an expense claim form, an application for CRA if you want to get a business number for tax purposes, and other business registration in Ontario. It depends on what your form of business is, whether you're a sole proprietor. So I've got this is a link to a website that's really good that takes you through all of that. I've got a sample HST return so you can see what that looks like. And I've got a self-employed business tax form. So if you are doing a sole proprietorship, what it's going to look like on your tax return. Just so that you can see, because some people don't know what they're looking for there. You know, they know that they've got one, but they've never seen one, and it'll be there for you. So that's it for me. I'm sorry that I went so long. I know I'm just so excited about all this accounting stuff.
No, we really appreciate you being so in-depth, Kelly. You know, your knowledge is greatly appreciated.
Is everyone still awake?
I hope so. Everyone's still there? Get everyone, yeah? Awesome.
Okay, I'm getting symbols from everyone. That's great.
Well, thank you so much, Kelly.
I do apologize for going over time.
I just want to say, sorry, this fly will not leave me alone all day today. I know it's after time, guys, but I just want us all to give Kelly like a big wave, a big thank you. Thank you definitely for joining us, Kelly. And please don't jump away, Kel, stay with us. Let's have a chat. If anyone has questions, please stay. We'll stick around for a little bit. We can go breakout room and have a quick chat if there's something you need from us. But that was a lot of information to go through.
A lot, and I apologize. It's just thick and heavy. Yeah.
But there's a reason we record this, right? So the module from today with the slides from today and this video are something you're most likely going to need to review multiple times. Tomorrow, we're going to be going through some exercises that will build on what you learned today. We're actually going to be going through the financial template. I'm going to explain to you how that whole template works, how the macros work in it. We're going to do a couple practice exercises to kind of get you used to all this and then be able to directly kind of apply what Kelly was talking about today. So, but yes, Kelly, thank you so much for joining us.
Yeah, I don't want anybody to go home and empty the bottle of sleeping pills. So know that as you start to do stuff, there is help. And really you do have to jump in to do it for your own business before it starts to take color. So Dave will have my contact information, and we talked a little bit about whether I might maybe pop back in again to help as you go through the exercises and doing some of this stuff for yourself. But I'm happy to continue to be involved and lend a hand. Don't tell my husband I said that.
Yeah, because you don't got enough
My
going
time
on.
for cleaning out our storage unit. Of all my fabric, I think.
Well, thank you for making yourself available, Kelly. Definitely, guys, take her up on the offer, because I know all of you are trying to get some of this set up right now, or maybe need some optimization. And as Kelly is definitely a valuable resource to ask these questions of. So,
And even if you want to talk about like your business, like when we talked about, there's a few approaches you could take, and which one is the best fit for your business. If you want to talk that through, and so you can, hone in on what you need to pay attention to and get rid of the rest. I'm happy to do that.
thank you, Kelly. We really appreciate it. All right, guys. Well, we will see you all back tomorrow, 1 o'clock. Please be ready to kind of follow along. So you will need to have, if you can, have Excel downloaded and up and ready on your computer. If not, if you don't have Excel, please let us know, because we'll make sure you can get that through our means. So definitely shoot me an email right away if you don't have access to it, because we'll need that to kind of follow along, or to use the template. But yeah, be ready to rock. We'll do a little bit more engaging stuff tomorrow. So there will be you kind of participating along. So have a great rest of your day, everybody. Kelly, feel free to stick around, and if others have questions, stick around as well.
Dave, I can send you a quick email about it, but I tried to download the Adobe and Microsoft 365 from FSU. And it says it's not available. So I don't know if it's this summer, because it's the summer semester.
I'll send you an email about how to deal with that, Ashley.
Okay,
Are you a
thank you.
current student? Because I thought it was only for current students.
I'm not doing school right now in the summer, but yes, I'm starting
Okay.
year 2 in September. So I would think I'm still qualified as a current student.
You should be fine, Ashley. You just need to email the IT service desk, that's all.
Okay.
I'll send you their contact information.
Sweet. Thanks, Kels.
Cool.
And I'm not sure whether I should say this or not, but I think I can still sign on to my FOL account, and I graduated in 2018.
Oh, quick, I better turn the recording off.